The market is forward-looking, but I'm not sure we are right now forward-looking enough to look through all the weakness that is going to come in the economic data.
I think it's time for some selective buying in the U.S.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
Corrections end on bad news. They don't end on good news.
What you'll probably see in here, the market's trying to find a bottom. There will be a bounce.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday following 4 straight weeks of losses, and the White House isn't blinking.
Corrections are healthy, they're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
So up next, the Fed decision, and Fed Chair Jay Powell showing very little interest in stepping in with rate cuts anytime soon, putting even more weight on this week's economic data. As consumer confidence drops and corporate America fires some warning shots, investor focus turning to U.S. retail sales later on this morning. Another read on the consumer, 8:30 Eastern Time.
Which is key, because right now, and it's good that you pointed out the idea that the Trump put maybe isn't as strong as people expected. Well, is the Fed put also a lot more difficult to really engage than people expected? Because even though we do see a softening in consumer demand, the real-time data seems to suggest that we're not seeing a softening in long-term inflation expectations, at least in the margins, which makes it difficult for the Fed to just full throttle embrace the weakness and respond to it.
UMich was spicy going into the weekend, so let's talk about some bullet points from the UMich consumer sentiment read. Consumer sentiment, the lowest since November 2022. Long-term inflation expectations higher. Households expecting higher unemployment at levels we haven't seen in more than a decade.
The consumer sentiment, it's obvious from this survey, is souring right now. And a lot of this is policy driven. If you look at the statement that came out from the director, many consumers cited the high level of uncertainty around policy. So it's not even the policy itself. It's the uncertainty waiting for it. And another nugget I thought was so important, nearly 50% of survey respondents just spontaneously started mentioning tariffs in the interviews that they conducted.
Wall Street is souring as well. Check out some of the forecasts we've had over the last week or so. Equity downgrades at HSBC, at Citi, price target cuts at Giardini, Costin over at Goldman Sachs, and now Lori Calvasina of RBC, dropping the price target on the S&P 500 from 6,600 down to 62.
It's about a 6% decline in some of her expectations for the full year. But she echoed what a lot of other analysts said over the weekend, which is it's difficult to know whether this is an entry point or whether this is just the beginning of a deeper pain in equity markets, because ultimately, as she said, the sentiment, the vibes aren't sending us a clear signal. And that pretty much was what everyone across the board said. Mike Wilson of Morgan Stanley, it will take more than just an oversold market to get more than a tradable rally. Stuart Kaiser of Citi, we will wait for better entry points.
If you're worried about policy, over the weekend, the president doubling down on trade.
Doubling down on trade. Him and Scott Bessent as well over the weekend talking about April 2nd being the big day when it comes to trade. That's when we will get these reciprocal tariffs. Neil Dutta, who'll be joining us, sat down with Paul Krugman and he talked about the fact that what the market was pricing in with Trump was tax cuts, deregulations, and then maybe tariffs. But on this program, how many times did we say tariffs is the first lever he can pull? Because he can do it from the White House unilaterally.
Neil Dutta, about 2 hours, 30 minutes away on this program, 8:30 Eastern Time, shortly after we get US retail sales. If you want the scores, equity futures right now pulling back by 0.5% on the S&P 500, following 4 weeks of losses on the S&P, the longest weekly losing streak going all the way back to August. On that losing streak, we'll catch up with Jonathan Stubbs of Berenberg later on this morning, plus Tobin Marcus of Wolfe Research as President Trump teases even more tariffs, and Lotfi Karoui of Goldman Sachs turning cautious on U.S. credit. We begin this hour with stocks lower as Treasury Secretary Scott Bessent dismisses market worries. Jonathan Stubbs of Berenberg writing the pullback in U.S. shares in the past couple of months is a better potential entry point. Valuation is still not supportive, but technical indicators are. Jonathan joins us now for more. Jonathan, welcome to the programme, sir. Talk to us about the technical indicators that you're looking at that provide you at least some encouragement.
Yeah, morning. I think, first off, we entered this year hot, and it's actually quite refreshing to hear
Besant's comments, it doesn't appear to be a slave to the market, which I think is healthy. Remember, US equities were 22.5 times on a 12-month forward PE. That's the third liquidity-driven sort of bubble that we have seen in the last 50 years. That was start of year. We're back to sort of 20.5 times on a forward PE. Some of the technical indicators, retail sentiment, the sort of the classics of AA, II, sort of bull bear spread, that hit last week. That hit sort of buy territory. RSIs have been sort of hovering around there for a while as well. So there's some sort of technical sort of friction into the US market. But the big question is, what has really changed? What has the Trump administration done to change the whole setup for US equities? Is the US actually now a broken trade on that basis? That's what I've been exploring with investors over the last few weeks. So do they think it is a broken trade? I don't think the market's come round to that, but work I did last year showed that the US equity market in market cap terms gained around $30 trillion of value from 07 to 23. And if you calculate a total policy impulse in the US, a sort of broad sort of number for monetary and fiscal, so change in central bank balance sheet, change in government debt, the US total policy impulse over the same period was $30 trillion. So pretty much a one-for-one relationship move with US equity markets. So given the sustainability question over sort of US fiscal, is the US now in a position where it's playing exactly the same policy which has driven American exceptionalism for the last 15 years, or is the Trump administration doing a 180, going in an opposite direction, trying to rewire America, remap the world? I think the latter is the case. So I'm not saying broken trade, but it's definitely a different proposition to investors today, in my view.
Jonathan, what are people waiting for to decide whether this is maybe a tactical trading opportunity versus maybe a bottoming out and a really good buy in the U.S.?
Yeah, I think the tactical opportunity, I can see I've written about. We came into this year saying we would look to buy lower on weakness, etc. We've had that weakness. Some of the tactical sort of technical frictions are there. I was updating our sort of forward grids end of last week, and for the US to enjoy 15% earnings growth, which is above consensus, and to be on what I consider a bull market multiple, which is 20 times PE forward in 12 months' time, that would give US equity markets 6% upside from here. So we have to stretch consensus. We're holding that sort of 20 times bull market rating. To get more than that, we have to see earnings growth 20% or higher, which is very unlikely. Or we're having to go back into that liquidity sort of bubble PE, which I also think is quite unlikely. So I think the US is in for a more sort of sober and somber year trading range. It'll pay investors to sort of stay nimble, nibble when we get the sell-offs like we have, but don't sort of buy into the wholesale change that we're just going bottom left, top right.
You framed it in a way earlier to sort of demonstrate that in the United States, a lot of equity investors have simply been reaping the benefits of a whole host of bazooka of fiscal spending. That fiscal spending bazooka has shifted to Europe, has shifted to China. Is that kind of what equity investors are going to do as well? Is that trade over in terms of the shift to European equities in particular?
Yeah, correct. I mean, I've put this in my sort of regime analysis over the last 3 years. I've called that Brave New World. I write about that all the time, and my framework has been very sort of simple, 3 parts. First, this is a world of political and geopolitical disruption. We're seeing lots of that. Second, this is a world of fiscal activism where big government is the order of the day when it comes to generating growth and even sort of equity market gains. And thirdly, this is higher for longer. So my Brave New World framework hasn't changed, but as you say, there's been a very significant shift and a delta change from a European perspective. I would go as far to say that Trump is actually driving European policy. And our view as of the last 6 months is that Europe had upside risk, still has upside risk, but less so than 6 months ago. The Chinese are obviously having to sort of battle against sort of disinflationary forces and sort of soft growth, but I suspect that they'll sort of muddle through as well. So yeah, I think the worm has turned. I think it's a big worm that's turned. And I think it means investors globally have got to take more balance in their global equity allocation. That probably means lightening up on US exposure and broadening out to the rest of the world. That's what we've been doing over the last few months, and that's what we'd recommend today.
Jonathan, we've certainly seen the Trump effect in Europe when it comes to places like Germany. You talk about how the reset when it comes to Trump 2.0 could have been extended pretend, tweak and modify, or wholesale change. And it looks like, according to your report, they're going for wholesale change. How long could we see the benefits of that, given it's going to cause a tremendous volatility on the pathway?
I think first, again, to recognise the lead in you had earlier, Besant and the Trump administration recognise this. They're trying to manage that narrative real time. And I think everyone takes a step back. The conversation I've had with investors over the last few years is that the US has been and is on an unsustainable path when it comes to debt levels, when it comes to sort of fiscal sustainability. So it needs addressing. A modest tweak doesn't do it. US government debt is forecast by the CBO to go from $36 trillion today to 56 within a decade. America eventually breaks under that weight of debt. So the Trump administration is resetting energy, it's resetting trade, it's resetting national interest, it's trying to reset sort of domestic policy around ideology as well. So this is a wholesale sort of, as I say, rewiring of America, remapping of the world. It's radical, it's ambitious, it's obviously running into huge sort of frictions domestically and internationally. But America doesn't have too many options at this point. Modest tweaks won't do it. It needs wholesale radical surgery. And that's what the Trump administration is trying to put through. We'll see how successful ultimately they'll be.
So far, they're willing to tolerate some pain as well. Unexpected in many ways. Jonathan, got to leave it there. Appreciate the catch-up. Jonathan Stubbs there of Berenberg. Talking about a reset, I think a lot of people have got to reset expectations. And that's what the OECD is doing this morning, cutting the world growth forecast, citing, guess what? Tariff fallout.
This is what a lot of people have been talking about, not only downgrading growth, but increasing inflation expectations and saying the Federal Reserve may remain on hold well into 2026. This is the conundrum that they face. The report is clear to say if the tariffs are not that 25% across the board levy, that potentially growth would be impacted less. They still see slower growth, though, from some of the deglobalization trends that we see around the world.
They're playing catch down. We've seen this from so many houses on Wall Street over the past week, from Goldman, Morgan Stanley, the likes of Deutsche Bank cautioning as well about growth too. JPMorgan, Mike Ferroli on Friday, Lisa, doing exactly the same thing going into the weekend.
A lot of people were expecting a little bit more of some sort of fiscal boost on one side. We heard a lot of businesses talking about tax cuts and deregulation as their nodes of optimism. Those have not been the nodes of optimism to start the year because, frankly, we don't see the time horizon for when that will get passed.
Equity futures just a little bit softer to start the week. We're down by about 0.4% on the S&P 500. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Just some of the details of that OECD report that you mentioned, its latest economic outlook. The report says that President Donald Trump's aggressive trade policy is setting the global economy on a path of slower growth and higher inflation. The Paris-based organization has cut its growth forecast for 12 G20 countries, and it warned against ratcheting up retaliatory trade barriers. President Trump says that he will speak to Russian President Vladimir Putin tomorrow as the U.S. presses for an end to the war in Ukraine. Trump says that the discussions will focus on territory, power plants, and dividing up certain assets. Speaking to reporters on Air Force One, the president said, "We are doing pretty well with Russia, and there is a very good chance for a deal." Now, the two astronauts stuck in space may be home as early as tomorrow night. SpaceX's Dragon capsule successfully docked at the International Space Station on Friday. The vessel was carrying a new crew, allowing marooned astronauts Butch Wilmore and Suni Williams to return home after more than 9 months in space. And that's your brief, John.
Just unreal. Absolutely unreal. Danny, thank you. More from Danny later on this hour. Up next on the program, doubling down on tariffs.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away because they had no clue what they were doing. We're going to be getting back a lot of the wealth that we so foolishly gave up to other countries, including friend and foe.
That conversation up next with Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. So here's the state of play early this Monday morning. Good morning to you. Equity futures negative by 0.4%. A growing list of downgrades on Wall Street. The latest name, RBC's Lori Calvasina, dropping her price target on the S&P for year-end from 6,600 to 62. Mike Wilson of Morgan Stanley Publishing overnight saying tradable rally possibly. Durable rally, short answer, probably not.
And part of it is because not just this question around tariffs, but also growth expectations for earnings have to be pretty high. And that's really what we were just hearing. That's the sort of, fly in the ointment at a time where consumers just are not getting out there to shop. We will get the latest read today for retail sales.
The equity read last week was really tough. The bond market did nothing. No comfort at all coming from fixed income. Yields barely moved. This morning we're down 3 basis points. The 10-year 428.13. Under surveillance this morning, doubling down on tariffs.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away because they had no clue what they were doing. And April 2nd, I would have made it April 1st, but you know what April 1st is? April Fool's Day. I figured, I don't like doing it, but I made it April 2nd. But it's a liberation day for our country because we're going to be getting back a lot of the wealth that we so foolishly gave up to other countries, including friend and foe.
So here's the latest this morning. President Trump saying both broad reciprocal tariffs and additional sector-specific ones are coming on April 2nd. The president suggesting added levies will be imposed on key industries, including autos, chips and pharma. Joining us now for more, Bloomberg's Tyler Kendall. Tyler, the president not backing down.
No, John, and President Trump, these comments signaling that we could see those reciprocal tariffs and those sector-specific tariffs you mentioned stacked on top of each other instead of just rolled in to one big calculation. And while senior administration officials have long pushed us to that April 2nd date, these comments that you're hearing do signal that President Trump appears ready to opt for that more aggressive tariff regime despite the recent market volatility. Importantly, he also went on to say that he is not expecting to implement any exemptions or carve-outs for his steel and aluminum tariffs that he implemented last week. As we know, many of our trading partners opted to negotiate with the U.S. instead of implementing their own retaliation. Of course, Canada and the EU examples to the contrary there. But it remains to be seen if any of those concessions are being made as these negotiations continue. Treasury Secretary Scott Bessent, in an interview over the weekend, did say that some of our most unbalanced trading partners are starting to lower their tariff barriers, although he didn't specify which countries exactly. But, John, it's showing that this administration does appear unmoved by the recent correction in equity markets, that they say that they are holding the course here for a more aggressive tariff regime. Both President Trump and Treasury Secretary Scott Bessent saying that this is all part of a pro-growth long-term outlook.
Tyler, when it comes to the tariffs, we have 20% rate now on China, 25% steel and aluminum, and 25% on Canada and Mexico, but a lot of carve-outs if you're trading under USMCA. What can we see on April 2nd?
Right. So we are expecting those reciprocal tariff calculations. We have to keep in mind this White House has said that those will include those non-tariff barriers like the VAT tax, like subsidies, lax IP regulations. The administration is going to roll that all into one. And then those sector-specific tariffs that this White House has said is adjacent to national security concerns like autos, pharmaceuticals, chips that this president wants to see lower and bring down. That's why the European Union we've been talking so much about, because we know that they could be hit particularly hard when both of those tariffs are combined. We know negotiations are already underway. Just look at Friday when we saw that meeting between Commerce Secretary Howard Lutnick and a Canadian delegation, but still not seeing much movement when it comes to how these countries are going to start to lower their barriers ahead of April 2nd. I'll just quickly add that in his interview over the weekend, Treasury Secretary Scott Bessent did give us a range. He said, look at April 2nd, but also look potentially towards June 30th, the whole of the second quarter, as the timeline that we could start to see those tariffs go up and down as those negotiations continue.
Tyler Kendall, appreciate the update from the nation's capital. To extend the conversation, joining us now, Tobin Marcus of Wolfe Research. Tobin, welcome to the programme, sir. Some people, and I stress some people, have been surprised by the amount of pain the administration is willing to tolerate here. From your perspective, just how far do you think the White House is willing to go in early April?
It seems like they're prepared to go big on this. And I think there's a huge range of outcomes that's possible on April 2nd. The value-added taxes that you were just discussing, that's the big question in terms of the reciprocal tariffs. If they roll out rates that don't incorporate value-added taxes, this will be a quite modest policy. If they do fully incorporate VATs, we're looking at rates in the 10 to 25% range on most of our biggest trading partners. And based on the way the president's talking about it, I think we have to assume that that will be included as they've indicated. Because if they don't, it's, I think, going to be a pretty underwhelming policy relative to the expectations they've been setting.
Well, the administration views differences in sales tax rates as an export subsidy. What can Europe do to get ahead of this?
Right. Countries cannot negotiate away their VATs. That's the entirety of the tax base in most of these countries. That would be like if somebody asked the U.S. to repeal the income tax as concessions in a trade negotiation, which clearly is not going to happen. I think the economic argument about VATs is very weak. They really are neutral to country of import. You're talking about, a German-made and a U.S.-made car. They're both taxed at the VAT rate in Germany. Neither is taxed at the VAT rate in the U.S. So there's no discrimination taking place. But the administration has been arguing that, this looks like an export subsidy because they're rebated at the border.
Tobin, we heard from the president and from Scott Bessent, the Treasury Secretary, both really talking about the big day being April 2nd. Do you expect any announcements, though, like the 200% on champagne and cheese and wine from Europe to happen before April 2nd?
In terms of further retaliation from trading partners, possibly. I think other countries are still digesting a lot of what's already been done. For the most part, I think countries have made their decisions about how and whether to retaliate. There are, I think, some countries where there is further retaliation that's in store, but they seem to be trying to maintain a little bit of strategic maneuvering room. China in particular has hit back a little bit, but not that hard based on the sort of severity of the 20% with which we've already hit them. And I think other trading partners of ours are also making their own calculations. So we'll see, again, exactly how severe they go on April 2nd. I fully expect there will be more retaliation at that time.
Heading into 2025, people were expecting the tariffs. They also were expecting, though, a wave of deregulation as well as tax cuts. That we have seen some deregulation, but tax cuts haven't really been the main discussion for a while. Do you foresee a time later this year where we'll be talking once again about fiscal expansion in the United States and not just some of the cuts?
So Congress has been working hard on the tax cuts. That process is proceeding. I think it's proceeding as quickly as anyone could realistically have hoped. We never thought that was going to get done before summer, and that's still what we're looking at. But that bill is going to be, there will be some nice goodies in there for the corporate sector. We'll probably get 100% bonus depreciation. We'll probably get R&D expensing. Those will pull a little bit of CapEx forward, to the extent that it's not being stepped on by uncertainty. But that's not going to be a massively stimulative bill, and we never thought that it would be. I think it will be a little bit expansionary in the early years, turn contractionary on paper a few years down the road. But, most of the cost is extending current policy. There are going to be some real offsets in there, in my view. And we don't have another 14 points to cut the corporate rate like we did in 2017. I think it was never going to be the same, level of favorable tax cuts that we saw during his first term.
They're moving really quickly, Tobin, and they're moving quickly on the foreign policy front as well. Just getting confirmation from the Russian side, something we had indicated by the President of the United States in the last 24 hours, that there will be a call between the Russian and US leader on the phone scheduled for Tuesday. That confirmed by the Kremlin just moments ago. Tobin, what are you looking for tomorrow? What's the outcome you'd expect from that call?
Yeah, I think that the Russian side seems like they want to make a show of being a good negotiating partner, but it's not yet completely clear to me that they're willing to kind of foreclose on their ambitions to keep making progress in the near term. They've believed for quite a while now that they're on the front foot. And so I think it's always been clear that one of the major obstacles to the sort of near-term negotiations Trump is trying to mediate will be, can you get the Russians to settle for the current status quo for now, or are they going to keep making these demands like, Ukraine ceding the remainder of these 4 disputed territories and so forth before even getting into the early ceasefire phase?
Tobin Marcus of Wolfe Research. Tobin, appreciate it. A highly anticipated phone call taking place between the President of the United States and the Russian leader set for tomorrow.
And it comes after his special advisor, Steve Witkoff, sat down in Moscow with President Putin. And over the weekend on the Sunday show, Steve Witkoff said he doesn't want to put words in President Putin's mouth, but he thinks that Putin agrees with Trump's philosophy, basically, on how to end this war.
What's the goal in terms of the timeline, though? And I think that's what a lot of people are wondering, is to cease the fighting in the near term and then hash out the details. Putin has talked about not wanting to do that so quickly. So this is sort of going to be an interesting moment.
We'll have more on that story in just a moment. And this one. Up next on the programme, Stephen Trent of Citi on his outlook for the struggling airline industry following that big downgrade to its forecast coming from Delta just last week. From New York City this morning, good morning to you all. You're watching Bloomberg TV. So here's the tone of the stock market right now, just a little bit softer. We're negative by 1/3% on the S&P 500. Similar move on the Nasdaq 100. Don't forget the Friday, the biggest one-day gain on the S&P going back to November. So the best day of gains so far this year, but not enough to erase that weekly loss. 4 consecutive weeks of losses on the S&P 500. The longest weekly losing streak going all the way back to August of last year. If you set up the bond market, the 2-year, 10-year, 30-year, when you see moves like last week in the equity market, you'd expect a bid in fixed income. You did not get it. Yields were higher on a 10-year by a single basis point. Lisa, the 10-year this morning down 428.
To me, this was the most notable aspect of last week. You could argue it's stagflationary light getting baked into the market expectations. You could also make an argument that this is Germany boosting yields globally because they are going to be borrowing so much money as they intend to have a fiscal injection both into infrastructure as well as defense spending. Nonetheless, there is an ongoing belief that bonds will not be the same kind of buffer at a time where the Fed is somewhat hamstrung from the fact that inflation expectations aren't coming down as quickly.
That's been the story of March so far, with the S&P 500 down around 5% on the month and bond yields on a 10-year up by close to double digits, even with that decline in equities. Lisa mentioned Germany, so let's finish on foreign exchange and take a sneak peek at the euro this morning. Euro dollar and a new forecast over at SocGen. Kitjukes looking for 113 in 4Q. Only 2 months ago, we were looking for parity at a lot of houses across Europe. Euro dollar this morning, 109.09.
And a lot of people making the argument that the gains that we've seen so far in the euro versus the dollar have been on the potential fiscal spending, not on potential weakness in the United States. When that starts getting factored in, suddenly that delta gets even bigger.
Key vote for spending in Germany. That vote starts tomorrow, so look out for that. We'll have coverage for you. On our radar this morning, President Donald Trump saying reciprocal and sector-specific tariffs are coming on April 2nd. Trump telling reporters that in certain cases, both types of levies will apply to imported goods.
April 2nd's the big one. They've been talking about this. I thought Tyler in Washington brought up a really good point. Something Scott Besson said over the weekend is it's not just April 2nd. Also look at June 30th. Basically putting the time frame on what will likely be a negotiation. Besson said either tariff barriers come down and the U.S. can export more, or they don't come down and then the U.S. is able to use those revenues. They're trying to at least project that this is going to be a win-win scenario, even though we are seeing it hit sentiment and consumers and, of course, the market.
The most important thing to see on April 2nd, does it give some certainty to consumers and to corporations? Does it give a sense of what the architecture of this tariff deal is? I see out of the corner of my eye you shaking your head. I think a lot of people are saying that uncertainty isn't going to go away, and the uncertainty tax people are trying to grapple with, as well as the framework that we may get.
I just find it hard to have this certainty on April 2nd if already Scott Besson is saying also look at June 30th. It already tells you that this is Trump in full-on negotiating mood, which he has been since he entered office.
And as you've said repeatedly, this is a feature and could be a feature of the rest of his second term. Let's talk about the foreign policy effort. The president saying he'll speak with Russian President Vladimir Putin tomorrow to discuss ending the fighting in Ukraine. Trump telling reporters there is a, quote, a very good chance for a deal. And much of the discussion will be about territory.
So they're discussing already what kind of territory, land. Trump keeps talking about power plants. I imagine they're talking about Zaporizhia, which is the biggest nuclear power plant in Europe. Russians have been holding it since the middle of 2022. One thing that is interesting following this meeting is I want to see signals of when these two individuals could meet, because I had reporting months ago, at this point now, that they were aiming for an end of February meeting. Well, we are now in March. Steve Witkoff has made already 2 meetings there. When are these two leaders potentially going to sit down?
In the meantime, Russian assets are rallying. And guess what? The OECD came out this morning, and improved Russia's 2025 GDP growth forecast to 1.3% from 1.1%. Key question is, how does President Trump and the administration go about doing this while having a deal that is unfair equally, where people are equally unhappy with the outcome at a time where it seems like there's a bit more leverage, at least on the Russian side?
We'll speak to the OECD in about 60 minutes' time, so don't miss that conversation. Wanted to get the latest data out of China because the data was pretty decent. Chinese consumption, investment and industrial production coming in higher than expected to start the year as the country braces for more tariff pain. Retail sales increasing 4% in the January-February period from a year earlier. That's the most since October.
And it should give people a boost of optimism. But you heap on top of that some of the rhetoric from Chinese authorities about their growth plan. And they're saying all of the sweet nothings that everyone has been waiting for so long, which is we want to boost consumer spending. We want to revive people's incomes so that they can go out and actually fund this economy. And that's that's giving people a lot of excitement, which is a reason why you're seeing a pretty positive response in equities.
Then you get into the policies, and the policies less impressive.
Yeah, they don't really do anything.
Right? Nothing at all.
But
it sounds great.
Also, the property market remains under immense pressure and unemployment is rising. So even though there are maybe some exciting things going on in China, when it comes to what is happening, when it comes to property and unemployment, it's still not a great game.
That's the latest over in China. Let's bring it back to the United States and turn to the US consumer. Retail sales due at 8:30 Eastern Time. The report coming after a disappointing UMich consumer sentiment survey dropped going into the weekend. Airlines leading the way as corporates start to lower guidance. Delta, American and Southwest slashing their outlooks, citing weaker than expected demand. Stephen Trent of Citi still optimistic on the sector, writing the main risk seems to be top down. When and how do we get clarity on the government's plans on tariffs, trade and foreign relations? Stephen joins us now for more. Stephen, good morning. Good to see you.
Same. Thank you for having me.
I think we've got to start with the downgrades to the outlook for the first quarter that came from some of the airlines, and it was kicked off by Delta just last week. Ed Bastian used the T word. The T word's a scary word on this programme. Transitory. Transitory. Just how transitory might this be?
Great question, and I think it's too early to say. So you did have a lot of noise in 1Q. Certainly, as you guys said, the airlines really dislike this uncertainty. So when are we going to get clarity on tariffs, on Dodge cuts, and what does all of this mean for demand? I think that's too early to say. During the quarter, at least so far as well, you did unfortunately have several high-profile aviation accidents. All but one of them were fatal. That is also something that you can't ignore in these short-term moves. But I think overall, what confidence do we have 6 months from now? I think it's way too early to tell. And the underlying fundamentals still look positive.
So let's gut check ourselves, because before we get carried away with too much negativity, not that I would ever be accused of that, I am wondering if it really was all that bad, what some of these airline executives were projecting.
Yeah, so look, I think if you look to your point, nobody so far has changed their full year guide. I think they're also in a wait and see mode to some extent where things go. Are we going to wake up a month from now and we'll have a little bit more clarity after this April 2nd bogey that Mr. Bessemer mentioned? Are we going to wake up and have some wild headline about Greenland and nobody wants to travel? I think it's too early to say, and it's a little too hard to put math on that today. But the underlying fundamentals still look positive. And I think the airlines telegraphed that by not making any cut to the full year guides.
There was a real question about how much of this was driven by consumer discretionary spending, people who might be worried about losing their job, versus companies really pulling back, saying, hunker down, study, you have got nothing to tell any of the clients.
Yeah, look, I think those are all potentially legitimate drivers. I would add to that what's happened on the government level, which is not the largest piece of travel, but with DOGE kicking in, less government employment, I would imagine they're also being stricter about who's allowed to go on business trips from these various agencies. So I think all of that stuff is relevant.
They certainly are. I hear that anecdotally, but also we saw it with United. Who is most vulnerable to that, those government contracts, those government flights?
Yeah, certainly United had not a massive number, but American United kind of sort of talked about having a smallish percent of revenue associated with U.S. government travel. So I don't remember exactly off the top of my head, but very low single digits, I think, in the highest case.
So not enough to pull roots?
No. But you also have to consider some of these markets where the government serves. So Washington, Reagan, of course, where we just had one of those awful accidents. The FAA had actually added a little bit of flights into that corridor recently. So you have a difference in terms of how much flow you get from some of these government employees and what kind of economics you get on them. So they were small numbers. But I think the question is, when the dust clears in all of this, how big are they going to be? We don't really know yet.
You also mentioned fuel prices in your note. A lot of banks are now cutting their forecast to Brent. How much is that going to be very helpful right now for the airlines?
Yeah, so I think lower fuel prices are helpful, and fuel's sort of a funny thing. Fuel prices that are too high are bad news. Fuel prices that are too low, also bad news. The latter signals a recession, for example. But where we are today with WTI in kind of the high 60s or thereabouts, it's at a level where it's not really doing any damage, or it's not dangerously cheap per se. And it did come down from levels where we're going to see lower unit revenue, at least short term. So it's actually good to have a little bit of tailwind from fuel today, but I guess if fuel and crude started to fall wildly, that wouldn't be the best signal in the world.
So I think a couple of things we're still talking about. One, did the weakness in February spill over to March? And within the weakness, is the premium segment, the international long haul, still holding up?
Yeah, so what we see so far, international long haul is still strong. You have a dearth of new equipment per capita in that space. On the wide body side, you really only have with Alaska, you have 4 U.S. airlines that have any wide bodies, really. And loyalty and co-branded card, the same. Domestic's been the main place so far that's been a little bit soft. And, the indications so far is that should at least continue somewhat into March, but, too early to say what's going to happen on the month.
Let's finish on domestic. What happens when you start charging for bags? What happens?
Yeah, it depends who you are.
What if you're Southwest?
So I think on one level, if you're a carrier that's for decades been dealing with a passenger flow that is elastic in terms of demand, it's a give and take, no? So I think what you're going to pick up and check bags, you're also going to run some risk of sending some passenger flow away to somebody else. And that also makes you arguably less distinct against basic economy of one of the big three. You're now offering something similar to them, and they have a massive network versus you if you're Southwest.
That's the question. Why did they do it? What's the logic behind it?
So I think for the discount airlines, there has to be some kind of change, strategically speaking. I think these post-pandemic structural challenges, the way consumers purchase tickets and decide to travel, all of that's changed. We no longer have enough air traffic control capacity per capita to allow these discount carriers to just lay a bunch of capacity and maintain really high block hour utilization. They need to do something on the unit revenue side. So is this going to be the fix? I don't know.
Just quickly, top pick right now for the sector. What is it?
Of the U.S. airlines, United's my favorite one, and then American Airlines and Delta.
All three, then? All three of the big players?
We're fans of the network, guys. They have everything they need to win. We just need the consumer to have a little bit more calmer water.
We'll get another read on the US consumer at 8:30 Eastern Time. Stephen Trent, good to see you, as always. Stephen Trent there of Citi. US retail sales, the next stop for this market. That comes later on this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A severe storm system over the weekend spawned tornadoes, dust storms, and wildfires that killed at least 36 people. The storm is moving into the southeast and mid-Atlantic, bringing thunderstorms, hail, damaging winds, and the potential for more tornadoes. Forecasters are warning of dangerous winds from Florida to New Jersey. China consumption, investment, and industrial production exceeded estimates in both January and February. China's pro-growth pivot in September fed economic momentum, but the Trump administration's tariffs threatened to halt that growth. It wasn't all good news in the data. The property market stayed under pressure and unemployment rose. Elsewhere, Oracle is accelerating talks with the White House on a deal to run TikTok. Politico reporting that the U.S. administration has significant concerns about what role the app's Chinese founders will play in its ongoing American operation. Vice President J.D. Vance says that he expects President Trump to wrap up a deal for the app ahead of next month's deadline. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on this morning. Up next on the program, the White House isn't blinking.
Corrections are healthy, they're normal. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
Up next on the program, we'll get the market view from Lotfi Karoui of Goldman Sachs from New York City. You're watching Bloomberg TV. Equities off session lows this morning. We're lower but by only 0.2% on the S&P 500. In the bond market, yields a little bit lower as well, down by 2 basis points. The 10-year 428.70. Under surveillance this morning, the White House isn't blinking.
Corrections are healthy. They're normal. What's not healthy is straight up that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
So here's the latest this morning. The Treasury Secretary, Scott Bessent, reiterating the administration's focus is not on the market, leading some investors to revise their outlooks. Lotfi Karoui of Goldman Sachs looking for wider credit spreads, writing, since the first tariff headlines broke, our message has been simple. Add hedges and brace for some rebuild and risk premia. Lotfi joins us now for more. Lotfi, good morning. It's good to see you.
Good morning. Good to see you.
I want to go back several months. I want to go back to the note you put out at the end of 24, going into 25, where you highlighted just how severe the valuation constraints were coming up into the new year. How much of a role do you think that's played in some of the shakeout we've seen so far?
A little bit. Obviously, when valuations are expensive, you don't have a lot of room to stomach these big shocks. But back then, actually, our message was that, yes, the market is expensive. Add hedges, add downside protection, and then wait for any signs that things are shifting, either fundamentally or from a technical standpoint. What we've learned the last 3 to 4 weeks is that things are actually shifting fundamentally. But the trade-off between growth and inflation is, in our view at least, heading into a direction that is unfriendly to risk assets. And so you have to realign yourself with that, and you have to push spreads a little wider.
Things are changing fundamentally when it comes to sentiment, when it comes maybe to demand that we're hearing from airlines, as we were just talking about. Has it really shifted, though, with the creditworthiness of these companies that have locked in borrowing costs for a long time and still seem to have healthier balance sheets than they have historically?
It depends where you look. If you're talking high-quality, IG-rated companies, probably not. I mean, if you implement tariffs, at the end of the day, it's probably worth a couple of points of declines in earnings. That will shift your credit metrics a little bit, but not too much. Where this will make a difference, in my view, is in the very low end of the high-yield market, where we ended the year with tight spreads in hopes that actually the economics of refinancing for some of these over-leveraged capital structures have gotten better. Now, I think what you'll see is spreads moving wider and that economics of refinancing getting a little bit more challenging again.
We just saw a week of the biggest widening in credit spreads going back to last summer's volatility. And I just wonder, is this a repricing of risk, to your point about valuation late last year? Or is this the start of something more significant where people shift maybe to places like, say, Europe and European credit over the United States?
This feels a little different to me relative to late July, early August, where we were actually pounding the table to buy the dip back then. This feels a little different because you need time to process what is effectively a meaningful dose of uncertainty that's been injected in the economy. The starting level for spreads is also very tight, and so it's not like you are being paid actually for this type of shocks. Europe has already outperformed, actually. Europe has had a phenomenal start to the year, both in credit and in equities. I guess I would describe European credit as basically being in the same situation as U.S. credit, 3 months ago, back to that valuation conundrums. So I think it's going to be very hard for Europe to continue to tighten in absolute terms. In relative terms, I think Europe will outperform the U.S.
There's this question at a time when the U.S. is potentially entering into a difficult patch of whether credit still has the canary in the coal mine aspect that it used to, whether it still kind of can forecast the sense of disruption in the fundamental economy that it had the reputation of doing 10, 20 years ago. Has that signaling mechanism been broken?
Yeah, I think that reputation comes entirely from the playbook of the global financial crisis. I don't think things will play out that way this time around. And so what we've seen now is literally credit moving in locksteps with its sort of empirical or beta relationship to the equity market. And so people complain all the time, well, actually credit has not moved. That's not true. We've actually repriced in terms of the change in spreads. If you look at the change in IG that would be implied by an 8.5–9% move in the S&P, it's exactly what you've gotten the last 4 weeks. And so it looks like credit is resilient only because the starting level is so tight. But if you look at the change in spreads, it's been commensurate, I would say, with the move in equities.
When John was talking about your note, you talked about the first headline from Donald Trump when it came to tariffs. Why now? Trump has talked about this from the very beginning, and we knew this was one piece of his broader plan.
Why now? Great question. I think what we've learned is that the administration has greater tolerance for a move lower in the market and even a full slowdown in the economy. To me, that's been the most critical piece of information that we've learned. And then valuation has remained very tight. The two other things I would add is that, and this is a big difference between today and 2018. In 18, rates were very low. They're not today. Actually, you get paid 4%, 4.25%. To invest in cash. And so you have a very valuable degree of freedom. Duration has rallied too, from a peak of 4.75 roughly to 4.25, but can rally more if you have an even bigger slowdown. And so to me, the urgency to buy the dip today is just not there.
I think we all remember December 2018 when the credit market totally froze up. I think that month for high yield, we got zero issuance in December 2018. Is there anything like that happening right now? Anything that would concern the Federal Reserve going into this two-day meeting starting tomorrow?
I think they'll most likely be in wait and see or on the sidelines. We'll learn, in terms of what they do with their own projections, how much they'll push inflation up and then how much they'll push growth down. But at the moment, like us, my guess is that they're processing this flow of information and trying to assess what they will do. Now, the market is pricing in, I think, 2 cuts for this year. That seems quite reasonable to me. You're pricing in 2 cuts not because you think we're going to make progress on inflation, but you're pricing in 2 cuts because you think the Fed will probably adopt some kind of an insurance cuts type of framework, exactly like they did actually in 2018.
Is the primary market still open for deals? We saw some headlines in the last week or so.
Risk aversion has gone up, and so the market is open 100%, but new issue concessions have gone up, and so, issuers have to pay a little bit more relative to the secondary to access the primary market. That's actually in and of itself, it's a healthy thing, because if you reduce supply, you kind of rebalance the market a little bit and you bring stability to the secondary market.
What are you waiting to understand the depth of what kind of correction we could see, or whether this is going to become something that you can opportunistically go into?
So at the single name level, I would say you're already seeing some opportunities. I mean, certainly the primary market is one way to deploy capital and harvest a little bit of alpha. But what could change my view, look, 2 things. One, you get a valuation reset. So actually you front load a lot of damage, you price it in, you make spreads interesting, then you revisit the conversation. The second thing, I think we need to remember that there's, in the administration's policy agenda, there's a lot of things that are pro-growth. And so if you recalibrate actually that policy mix away from some of the stuff that is actually negative to growth into some of the things that are positive for growth, tax cuts is a good example, deregulation, et cetera, then I think you have a different conversation and you would look at this market a bit differently.
I sense that's still the strategic anchor of a lot of the bulls out there, that the overall policy mix is still pro-risk, pro-growth, and in 6-9 months' time, things might look a little bit different. That's the hope anyway.
The first half of the year is Biden data, and then when Trump data comes into play...
We were told that,
yeah. Then there's going to be a policy mix that's more supportive to things going better.
Lotfi, it's good to see you. Thanks for breaking this down. Sharp as always. A clinic on credit from Lotfi Karoui there of Goldman Sachs. Equity futures right now in the S&P are raising losses, down by just 0.2%. Up next on a programme, Bob Elliott of Unlimited, Henrietta Treyz of Veda Partners, the OECD Secretary General Mathias Corman, and Zief of JPMorgan. From New York City, the second hour of Bloomberg Surveillance. Up next.
We don't know what the pass-through of expected and actual tariffs will be.
The tariff policy on again, off again, is impacting the sentiment of consumers.
Tariffs, of course, also in particular impacts anyone who's associated with trade with Canada and Mexico.
Tariffs are going to raise prices, and middle and lower income consumers have to bear more of the weight.
It's going to be very tough to pass this to consumers because the consumer is highly elastic in terms of looking for alternatives.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now. Your next stop for this market, 90 minutes away, 8:30 Eastern Time. U.S. retail sales, another read on the U.S. consumer. Then later this week, a Federal Reserve decision with Chairman Powell, a news conference and forecast. Going into all of that, equity futures are raising this morning's losses, still negative by about 0.2% on the S&P 500. Following 4 weeks of losses, the equity bulls need some better data.
And they need some better data from the companies themselves, who last week indicated that demand has rapidly fallen off a cliff. It raises a question: where is the market most asymmetrically positioned heading into retail sales? For a quickly deteriorating economy where people are stopping spending, or where people are potentially, really hanging in there a little bit better than people expected?
The soft data is soft. The guidance coming from the likes of the airlines, not great. We'll see if we get this at 8:30 Eastern Time. Will that confirm some of the gloom that we've seen in various places across various dimensions over the past few weeks?
Stephen Trent said that some of that weakness has carried into March. We've heard those ongoing warnings for a number of companies. That said, can we say it's still too early? Or are we going to start to see it bleeding into the hard data? Torsten Slok of Apollo last week came on and over the weekend put out a note where he said, expect it to start bleeding into the hard data. At that point, how much more of a downside does this market need to price in?
I know that you, Mitch, is tainted by political views.
It triggers
And we know
people.
there's some problems with that survey, and we know it triggers a lot of people. But the headlines coming from Friday, that was a very ugly read. The weakest read we've seen going back to November 2022. Inflation expectations, long-term inflation expectations, pretty ugly. And then you've got this anxiety around unemployment, which is something that Neil Dutta of Renmac would talk about a little bit later. Anxiety around unemployment started to climb.
Anxiety around unemployment, anxiety around what is going on in terms of policy. This was coming out in the statement. And when it comes to the politics, Jonathan, regarding it, what you heard from the University of Michigan is that consumers from all three political affiliations are in agreement that the outlook has weakened since February. Long-term inflation expectations, 32-year high. This is challenging right now, especially ahead of retail sales.
This does trigger people. I mean, I just want to put that out there. I put out a note about the Unmish survey on X, and I got a lot of hate mail saying, oh, super liberal survey, because people say it breaks down between partisan parties. But what you did see when you dug under the hood was that deterioration was widespread. And it crossed party lines, albeit from a very low base among Republicans. But independents also saw that deterioration and increased their expectations for inflation. All this said, it's going to be difficult for the Fed to justify cutting rates proactively if long-term inflation expectations are creeping up.
There is a political bias in you, Mitch. With that, I don't think we can disagree. That's just the reality of the survey. But I don't think there's a political bias over at Dick's Sporting Goods or American Airlines or Delta, for that matter, over the last few weeks. When they tell you the business is slowing down, I don't think they say that because they like Joe Biden and don't like Donald Trump. I think that's because the business is slowing down.
The real question going forward, Neil Dutta actually addresses this really well, is how much is this slowdown going to bring down prices or continue the disinflation? Or do we see that stagflationary-like price action that we're seeing right now in markets? Do these companies pass it along to consumers? They spend less but pay higher prices, and that keeps inflation pretty sticky.
Equity futures right now erasing this morning's losses very slowly and then quickly all at once. We're down by just 0.1% now on the S&P 500. Coming up this hour, we'll catch up with Bob Elliott of Unlimited, with markets looking to recover following another week of losses. Henrietta Treyz of Veda Partners as President Trump reiterates more tariffs are coming, and the OECD Secretary General Mathias Corman as the organisation cuts its global growth forecast. We begin this hour with stocks pushing lower as Treasury Secretary Scott Bessent says that recent corrections are, quote, healthy. Bob Elliott of Unlimited staying cautious, writing, it's important to note the S&P is back to about where it was in October. A recession is not being priced in. Bob joins us now for more. Bob, good morning. Good to see you.
Good morning.
How would you describe this repricing that we've seen over the past month?
Well, I think what we've done is we've wiped away some of the post-election euphoria that this was going to be, the most pro-business administration in the post-war era, and we were going to have an economic boom. People are tamping that down and basically so far saying, okay, disinflationary boom probably not going to happen, but they're still pricing in pretty good growth conditions in the face of what is a mix of policies that's very growth negative over the course of the next 6 to 12 months.
Mike Wilson of Morgan Stanley publishing coming into the new week saying this is not just about tariffs, it's about other issues. Do you agree with that?
Well, I think it's about the complexity of the whole mix of policies that are here. In many ways, we're seeing sort of a wrecking ball of policies with weaker immigration, tariff policies, cuts and significant pay-fors that are probably going to have to happen in order to get the TCJA passed. And that combination of things is all quite growth negative. And then on top of it, you're seeing a Fed which is pretty handcuffed here to respond to any growth weakness that they're seeing. And so that combination of things with an administration that, at least so far, doesn't look responsive to equity market weakness is a pretty bad combination for growth prospects and equity markets ahead.
This is a pretty bearish view. How bearish are you? How much more downside do you see?
Well, if you just look at how much stocks have outperformed bonds on a risk match basis over the last 3 or 4 years, the U.S. exceptionalism trade, we've corrected 5 to 10% on something that is outperformed by several 100% over the course of 5 years. If investors start to question whether U.S. exceptionalism is the path ahead, there can be considerable repricing that we see in the market.
And something that you pointed out is you see bonds actually outperforming stocks this year, which was a sort of a reversal of what we've seen for the past few years. And yet you do see the Fed constrained. So this isn't necessarily that bonds are performing so well, but rather that stocks are performing so poorly, no?
Well, I think last time I was here, Secretary Bessent was in just ahead of me, and he said he was looking for bonds going down, bond yields going down, every week. And since then, he's gotten stocks going down 4 weeks in a row and kicking off the week going down further. So he might be getting his bond rally, but as I said then, it's for bad reasons, not good reasons.
When was the last time that you saw a mix like this?
This is a very challenging policy mix. This significant growth negative set of policies. I mean, really the last time that we saw such growth negative policies relative to conditions was coming out of the financial crisis, where we had the Tea Party efforts to constrain fiscal spending at a time when we needed significant stimulation. Now, of course, the economy is stronger today than it was back then, but that push, that sort of exogenous push for growth negative policies is similar to that period. And that was a challenging time for Wall Street and also Main Street.
We've heard this a lot from various investors, but their assessment seems to be the following, that the policy mix becomes more positive as the year grows older. Do you disagree with that?
Well, if anything, it's going to take some time to get these policies in place. I mean, particularly the negotiations over appropriations for the next fiscal year, which will happen over the course of the next 6 months, will give us a view into whether there is going to be meaningful cutbacks in terms of government spending and any efforts to really balance or get close towards balancing the budget. I think the thing that's interesting is that budget policy that was passed suggests, several $100 billion a year worth of pay-fors for the TCJA extension. You put that into the budget combined with, some DOGE cuts and things like that. That is definitely likely to cut the overall spending picture in, the next fiscal year.
But Bob, they're talking about maybe getting reconciliation done by Memorial Day. I mean, that's 2 months.
Yeah, and if that's true, then what's going to happen is you're going to start to see that get priced into the market. I think in part what we've seen in the last couple of weeks is not only are we seeing significant policy uncertainty, and that is causing basically anyone with any sort of risk or levered position to cut back on their positioning, but that tilt that we're seeing is increasingly seeing expectations that the new administration is very committed to this set of negative growth policies, and that'll start to get priced in not when the spending happens, but when we actually start to see those policies enacted.
Is the extension of TCJA not enough?
It doesn't do anything. That's the big thing. While the political rhetoric will call this tax cuts, from an economic perspective, it makes no difference. And the reason why that is it's current law. And given that it's current law, simply extending current law avoids what would have otherwise been a big tax hike, which would have been growth negative, but it is not a growth positive on its own.
Would we still have this volatility in the market if Kamala Harris had won? We were sitting here debating whether or not tax hikes would be going up at the end of the year.
I have no idea what we would be if Kamala Harris was in office, but what I do know is the concern, the volatility in terms of a policy perspective is really about the totality of all the policies. And really, I think in the last couple of weeks about the tariff policies. I mean, what is tariff policy over the course of the next, 3 to 6 months? Is it 25% tariffs on our biggest trading partners? Or is it zero? Because it's been both over the course of the last 30 days. And if you're managing money or running a business, the only thing you can do in that sort of circumstance is pull back, cut back. And that's why we're seeing a broad-based cutback in confidence, not just in the Michigan surveys, but we're also seeing it in CEO confidence, which is now at the weakest level it's been in more than a decade. And given that, it's going to be very hard to get those sort of animal spirits that are hoped for to really continue this economy right now.
Step up Chairman Powell. If things are as bad as you say they are, why isn't he prepared to step in sometime soon?
Well, he is really handcuffed by the inflation picture. I mean, while the headline numbers for PPI and CPI came in below expectations, the PCE expectations continue to be elevated. They're too hot for him to continue to cut. And let's be honest, I don't think he necessarily cares too much if he can hang weaker economic conditions on the new administration.
I'll just jump in. How unusual is it to see inflation expectations climb against the backdrop of lower energy prices? How unusual is that?
Well, it's pretty unusual, but it's also pretty unusual to shift tariff policy up from essentially, close to zero, multi-decade lows, all the way up to the highest level since Smoot-Hawley, right? So that is getting priced in. People are digesting that, and that has a meaningful influence on what you're seeing in those expectations.
So are you one of those people going to the Bank of England and loading up a suitcase with gold bars, sticking it on the airplane and going home and hiding?
Well, I certainly couldn't carry a whole suitcase worth of gold bars.
All right, well, what are you doing?
But paper gold looks good in this sort of scenario, and it's a little lighter to trade. Looking at assets that are going to do well in a lower growth environment, particularly relative to stocks, things like bonds and gold relative to stocks, and weaker dollar in the circumstances. The U.S., we haven't really talked about the global picture, but the U.S. is tightening and engaged in growth slowing behavior just at a time when globally we're seeing out of Europe and out of China a real push to reaccelerate those economies. And that will really call into question whether or not the U.S. exceptionalism trade, should continue. And there's a lot of capital that hasn't repriced that trade.
Can you imagine the excess baggage fees, Southwest, trying to move gold around the country?
Well, can you imagine? I mean, the workers' comp for people's backs having to lift that stuff.
Have you ever held a gold bar?
I haven't.
Ridiculously heavy. Just ridiculously
Can you imagine?
heavy.
I mean, we heard about this. It affected GDP expectations for the first quarter.
Absolutely wild. Bob, it's good to see you. Appreciate a catch-up. Thank you, sir. Bob Elliott there of Unlimited. Equity futures just about negative on the S&P 500 with an update on stories elsewhere this morning. With your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. At least 36 people have died across 6 states since a massive storm system moved across the U.S. starting last week. And another round of storms swept into the eastern U.S. yesterday. The National Weather Service says that severe thunderstorms will bring damaging wind and a few tornadoes this afternoon and evening. Elsewhere, U.S. Defense Secretary Pete Hegseth says that strikes on Houthi militants in Yemen will be unrelenting until the group stops attacking ships in the Red Sea. Donald Trump ordered a new wave of airstrikes over the weekend. Hegseth said that the latest strikes are also warning to Iran, which backs the Houthis. CEOs of some of the world's largest companies will be heading to Beijing next week, with some planning to meet President Xi Jinping. Sources tell Bloomberg that plans are being made for the heads of Qualcomm and Saudi Aramco to meet with the Chinese president. And that's your Bloomberg brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the president doubles down.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away, because they had no clue what they were doing.
Henrietta Treyz knows what she's doing. She joins us next from Veda Partners from New York City this morning. Good morning. Equities just a little bit softer here, down by 0.1% on the S&P. Bond yields a little bit lower, down by 2 basis points, 429. So far, not much drama. In the FX market, 109.07, positive by 0.2%. A new call from Kit Jukes over at SocGen, looking for 113 on euro dollar. That currency pair has moved very, very quickly to start the year. That currency pair this morning positive by 0.25%. Under surveillance this morning, the president doubles down.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away, because they had no clue what they were doing. We're going to be getting back a lot of the wealth that we so foolishly gave up to other countries, including friend and foe.
So here's the latest this morning. President Trump pressing ahead with his tariff agenda, confirming reciprocal and sector-specific tariffs will begin in just over 2 weeks' time. Bloomberg's Tyler Kendall joins us now from Washington with more. Tyler, just how misleading is that April 2nd date? How much longer could this all take?
Well, John, it could take months potentially after that. We heard from Treasury Secretary Scott Bessent over the weekend telling us that we should really be looking at a range from April 2nd to, he said, in his words, say June 30th, the end of the second quarter, for those tariff negotiations to go up and down. And it really, after these comments from President Trump over the weekend that he is going to pursue this more aggressive tariff approach, potentially stacking those reciprocal tariffs on top of sector-specific tariffs, we'll have to see how that impacts negotiations with our trading partners, as many opted for talks instead of large-scale retaliation. Importantly, President Trump also there, as you heard him, he alluded to the fact that we are already starting to see tariff revenue come in from the tariffs that have been implemented. Now, we don't have specific numbers, but I do bring it up because we often talk about tariffs as a revenue raiser going hand in hand with implementing President Trump's tax cut agenda. Senior administration officials keep pointing us to the fact that when there is tariff uncertainty, this is all about a longer-term growth agenda. John, Bloomberg News reporting that some in President Trump's orbit are pushing for that tax cut agenda to get done by May. Our read on it is that that is highly unlikely. It does go to show how officials are trying to get more money into consumers' pockets, as these indicators that we often watch, like consumer sentiment, the 5 to 10 year inflation expectations, do sour. And while we talk a lot, John, about this potentially higher tolerance that we're seeing from this administration when it comes to market volatility, we're going to start to see a lot of opinion polls come out rating this first few months of the Trump administration. We'll have to see if that serves as any counter to this administration's policies.
Tyler, when it comes to the tariffs, do you get a clear sense if they're a negotiating tactic right now by the administration, or they truly are going to be revenue raisers for their tax agenda?
Well, Annmarie, this administration is trying to push that it could be a win-win here either way. And they've often pushed that tariffs accomplish a multitude of goals. For example, if we go back to the original tariffs against Canada and Mexico, that was for the border policies. Then steel and aluminum last week is trying to accomplish the national security items, which we're also going to see that rhetoric come back up again with those sector-specific tariffs, particularly when it comes to chips and autos on April 2nd. But this administration really pushing that at least the first step is to rebalance trade, try to get back to an even playing field, and then they will take it from there, particularly when it comes, if they don't lower those tariff barriers, then the positive could be that they will have this revenue raiser, which is going to be important to that long-term fiscal agenda that we keep hearing about.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. Tyler mentioned briefly opinion polling. We had some over the weekend. And the standout wasn't about the president. The standout wasn't about the economy. The standout was just how poorly the Democratic Party are polling in this country right now.
I think it's one of the worst polls they've had ever when it goes back to NBC polling. They can just not get it together. And the infighting was on display last week. And this poll was done even before that infighting started. And Chuck Schumer said, OK, we're going to allow the Republicans to pass through this continuing resolution to keep the budget open, which you've seen a tremendous amount, the government open, tremendous amount of pushback, especially from House Democrats.
27% of registered voters view the party positively in an NBC News poll. Unreal. Joining us now to build on some of these conversations, Henrietta Treyz of Veda Partners. Henrietta, welcome to the programme. Overall, I would say on net, the people that come on this programme don't like tariffs. There is some pushback sometimes, but on the whole, they don't like them. The market participants, they do like tax cuts. Now, we're trying to understand whether we'll get those corresponding tax cuts anytime soon.
Well, if you listen to the White House, they're trying to bill the one thing that is happening here, tariffs, as tax cuts. You know, when Peter Navarro and other economic advisors in the White House come out and say that tariffs are tax cuts, that's obviously, either you're lying to yourself or you're lying to me, but it's not correct. And that's the problem that we run into, because the same is true on the tax cut side. As your previous guest was discussing, the bill that they're trying to pass, by Memorial Day, whenever it passes, I don't care, they're extending the status quo. So there are no tax cuts even built into the $4.6 trillion tax bill that they need to pass this year. So there are tariffs and there are not tax cuts. And when you sell tariffs as tax cuts, you create a pretty material disconnect between the consumer, who is confused now about what they should be expecting, which is why you see pullback at the big box retailers and people delaying big purchases, which is what's leading to that soft data that's so problematic right now.
Henrietta, what happened to the carrot and stick approach when it came to tariffs and corporate tax rates? I thought if you produced in the United States, potentially you could get a 15% corporate tax rate. Where did that conversation go on Capitol Hill?
That conversation is nowhere right now on Capitol Hill. Each percentage point reduction in the corporate tax rate costs $150 billion. So as I mentioned, we're already at $4.6 trillion just for the status quo. We got to fix the SALT cap, even just to raise it up to $20K for couples filing jointly. We have to extend the child tax credit. The president wants to do things like eliminate taxes on tips, which is itself $175 billion. We do not have the money for a 15% corporate tax rate. And even if you did, I'd like to relay that the Republican conference and members up there do not support additional tax cuts for the business community. They view the 2017 tax bill downfall. The one piece that was really unpopular is that the corporate rate cuts were permanent, and all the individuals in the United States are now subject to a tax increase at the end of this year because of the 2017 bill. So there's not a lot of appetite for tax cuts at the corporate level.
So, Henrietta, what kind of extras can we get? Do we get no tax on tips, no tax on Social Security? What could Trump put on this to make it more than just an extension of TCJA?
That's a great question. The no taxes on Social Security is physically not possible. They're not permitted to address Social Security in any capacity using reconciliation instructions. So that's entirely off the table. And just so we're clear, the cost of doing that would be $1.8 trillion. So if it was not physically impossible, it's definitely monetarily impossible. The no taxes on tips piece doesn't have a tremendous amount of support because there's not been enough education or discussion of how to rein that in so that you don't avoid, a CEO saying the $1 million that I made last year is actually just a tip and evading taxes. So they don't have the logistics worked out for that. And then in addition, that's not a universal tax cut for all individuals. It's only a tax cut if you get tips, which not everybody does. So it's disproportionately impactful to different states. That was a big sell in Nevada, but Nevada does not have Republican senators. So it's going to be really difficult to get that over the finish line. There's not a lot in there that can be described even charitably as stimulative. There are a couple of business-related provisions that expired in 2022 that we could provide a short-term extension of, but that's really it.
Henrietta Treyz there of Veda Partners. Henrietta, thank you for the update. Appreciate it. We've had a lot of downgrades to growth off the back of some of the policy volatility of the last few weeks, including downgrades from JPMorgan, from Goldman, from Morgan Stanley. In just a moment, we'll talk about the OECD doing exactly the same thing, dropping their growth forecast and raising their inflation outlook.
Yeah, exactly the mix that people don't want to see, and talking about the Federal Reserve not really having the ammunition to cut into potential weakness.
Coming up on the programme, we'll catch up with the OECD Secretary General, Mathias Corman, on global growth risks. Looking forward to that conversation. Check out the equity market as we go to a commercial break. Equity futures just about negative by 0.1% on the S&P 500. In the bond market, bond yields just a touch lower, down by 2 basis points at 4.29. The next stop for this market, US retail sales in about an hour from now. The last major data point, the last read really on the US consumer going into the Federal Reserve's 2-day meeting, which kicks off tomorrow and concludes on Wednesday. Chairman Powell set to deliver a rate decision. No change to interest rates expected, but plenty of changes to the forecast in store. So look out for the news conference 30 minutes after that decision. From New York City this morning, good morning. I mentioned briefly moments ago the downgrades to economic growth we've seen from JPMorgan, Morgan Stanley and the like. We've also seen downgrades to the equity market view as well from HSBC and Citi, and more recently from Goldman Sachs and David Costin dropping their price targets on the S&P 500. Lori Calvasina follows today from RBC, cutting the price target on the S&P for year end from 6,600 down to 62. With that in mind, equity futures right now are raising some of those losses. We're negative by 0.2% on the S&P. On the Nasdaq 100, we're softer by not even 0.1%. Let's get you some morning calls, some morning movers. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. We start with NVIDIA. Those shares are up 1.3% as we await the company's giant AI conference, which kicks off today. But the big event will be tomorrow with Jensen Huang's speech, where he's expected to unveil more details about future versions of its AI chips. But as we know, a lot is riding on this moment because this year has not been kind to NVIDIA. It has also not been kind to our next stock, which is Tesla. Those shares now are lower by 0.8% and leading the broader tech sector lower. And this I found interesting. A Danish pension fund with $20 billion AUM says it's selling its remaining 200 Tesla shares and blacklisting the company, meaning it won't buy any more shares due to what it says are growing risks posed by its founder and CEO, Elon Musk.
Johanna, thank you. That stock a little bit softer in the pre-market, down by about 0.9%. On our radar this morning, Treasury Secretary Scott Bessent saying recent market turmoil isn't rattling the White House.
Corrections are healthy, they're normal. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
The White House, the Treasury, they're not blinking. And going into Wednesday, a question we've all got, well, Chairman Powell.
Yeah, at the same time that we're seeing inflation expectations creep higher in a number of different surveys, you can say what you will about the University of Michigan. This is going to constrain their ability to really say we can proactively cut rates, and that's what we see in market pricing in. If that's the case, if no one's blinking, where's the relief valve for a market that's facing off with slower growth, policy uncertainty, and a Fed with a sticky Fed policy rate?
The problem right now this administration has is right now the markets, the consumers are dealing with only one part of their entire agenda, and that's tariffs. You heard from the Treasury Secretary there talking about when you look at it overall and long term, we're talking about tariffs plus deregulation plus tax cuts. Well, right now we only have one pillar of that agenda, and that is what's making this so complicated for them.
We're talking about foreign policy too, so let's turn to our next story. The Defense Secretary Pete Hegseth saying U.S. strikes on Houthi militants will be, quote, unrelenting until the Yemen-backed group stops attacking vessels in the Red Sea. President Trump on Saturday ordering the first round of attacks on Houthi targets.
So Pete Hegseth, the Defense Secretary over the weekend, really made clear two things. Freedom of navigation, which we have seen basically American troops, men and women, protecting Chinese and Russian vessels, the only ones willing to go through the Red Sea. They want that to end, and also they want to restore deterrence. Your Age Group put out a note, made a very good point. We have seen attacks even under the Biden administration when it comes to the Houthis, but not at this scale. And I spoke to a number of officials over the weekend. What I'm hearing is this is likely going to be definitely days and potentially weeks, and what this administration is willing to do to set deterrence and really go after the Houthis.
I wonder how much this actually ties into the economic story. They've cited inflationary impulses from some of the shipping delays that we've seen, and we have seen that. How much is this part of that? If you open up that corridor and create the freedom of the seas, once again, that reduces some of the pressures, at least on the margins.
They were very critical of the previous administration for totally failing to provide and establish a deterrence in that part of the world. It was kind of shocking. Week on week, month on month, we saw these developments and hardly anything was done.
And maybe now commercial ships, which are going around the Horn of Africa, will actually start, to Lisa's point, use the Red Sea. Also, this is sending a clear message to Tehran and what this administration is willing to accept in terms of Tehran's support for proxy groups like the Houthis.
They have been very clear about that. Just wanted to squeeze this in from the ECB. The ECB Vice President, Luis de Guindos, saying President Trump's policies are causing more economic uncertainty than COVID did. The Vice President joining several policymakers highlighting worry about a brewing trade war. Now, sometimes we're too dramatic. I don't know what happens in our personal lives, but that is very, very dramatic to say something like that.
At the same time, we just heard that from Bob Elliott, that frankly, he hasn't seen this level of uncertainty or at least a negative growth mix going back years. It raises a question about whether there is a sort of well-oiled plan that's getting executed, or whether people outside the U.S. are correct in feeling like it's 200% tariffs one day, 200% tariffs another day that are withdrawn. I mean, it's very difficult to keep track of all the tariffs, let alone see what the overarching plan is, especially if you are on the receiving end of some of these tariffs.
I don't think you can compare this to the pandemic. Being locked in your apartment, needing a passport to go and get a cup of coffee to prove you were vaccinated.
I think that it's a different kind of uncertainty. I mean, there was sort of an
Being
existential
forced to
uncertainty.
hang out in certain bubbles with certain people. I don't know. And also the tariff plan we don't even have
people,
yet.
What was wrong with your bubble?
True. Jonathan was in my bubble when he was in London. No offense to Jonathan, but you weren't really allowed to expand outside, the people you saw every single day. On top of that, we don't even have Trump's tariff policy. How are you throwing all these daggers at it when actually we don't have the policy?
In fairness, during the pandemic, and I'm not talking about it from a personal bubble issue, you can talk about that all you want. I'm talking about this from an economic perspective. And back during the pandemic, there was a sense of economic cooperation between countries. And that created a sense, we'll do what it takes to actually try to revive the economy. A whole host of uncertainty. That, I think, is the aspect that is getting people concerned. What is the framework even that we're operating in?
Curious how willing they are to criticise US policy and how unwilling the Europeans have been to criticise policy coming from China, particularly around the pandemic.
Couldn't agree more.
In the months and years after that. So plenty of questions for the Europeans on that front, that's for sure. Let's get to the OECD, out with its latest economic outlook, saying President Donald Trump's aggressive trade policy is abruptly setting the global economy on a path of slower growth and higher inflation. The organisation saying, quote, significant risks remain. Further fragmentation of the global economy is a key concern. Joining us now to discuss is the OECD Secretary General Mathias Corman. Mathias, welcome to the programme, sir. It's fantastic to get your insight on the global economy. When you downgrade overall global economic growth, can you lift the lid on that call for us and just go beneath the surface? Where are the biggest downgrades, revisions to growth on a country-by-country basis?
Well, on a country-by-country basis, I mean, the biggest impacts that we see are in Mexico and in Canada, for obvious reasons. But if I just go back, I mean, at a global level, we are downgrading our growth outlook for this year by 0.2% down to 3.1%, and next year by 0.3% down to 3%. And I mean, it's a function of the data pointing to a weakening in the global economic outlook, but also inflation remaining more elevated than we had previously anticipated. Of course, the very high levels of policy uncertainty, which is weighing on growth, because of its impact on both consumers and investor confidence and likely future investment decisions.
Secretary Mathias, how much do you see the U.S. getting penalized just as much as the rest of the world when it comes to downgrading the growth trajectory as a result of tariffs? Or is it still the idea that the rest of the world will see a bigger hit than the United States?
Well, we do see a negative impact on the economic outlook in the United States, but it's a lesser impact on the basis that the U.S. has a comparatively large domestic economy, of course, and trade as a share of GDP is of less importance in the United States than what it is in other countries around the world. I mean, in particular, when we look at Canada and Mexico, who have got very comparatively higher trade exposure as a proportion of their economy, but also, and in particular, high trade exposure to the U.S. market, then clearly the impact there is somewhat more significant. But the impact is also material and negative in our outlook for the United States.
How much do you have a framework to even price in what the outlook is for trade? I mean, we were just talking about how April 2nd, hopefully we'll get more clarity. We hear from every company the issue isn't just the tariffs, it's a lack of certainty around what the policy is going to be. How do you even come up with a model for this?
Look, I mean, we are making certain assumptions, and certainly, I mean, for us, we work on the basis of what is announced and or legislated policy of an elected government. But the uncertainty in itself is certainly weighing on growth. But as a matter of general principle, what we would say is that there is, when it comes to global economic growth, when it comes to continuing to lift incomes and living standards for people in countries around the world, keeping markets open, having well-functioning global markets, having a rules-based trading system in good working order is still the best recipe. And to the extent that there are issues between countries in terms of fairness or perceived unfairness in terms of policy issues that need to be addressed, that is best done through bilateral or multilateral dialogue rather than through unilateral measures.
To build on Lisa's point, your calculations don't account for what Trump is set to announce on April 2nd. Also, some other items he's announced, like a 200% tariff threat on European wine, cheese, and champagne coming into the United States. So after April 2nd, or maybe a few months after that, June 30th, do you think you're going to have to revise down some of your growth forecasts?
Well, we are pointing in our revised forecast today. We are pointing to significant downside risks, including, when it comes to further trade fragmentation or increased trade tensions because of further measures, which clearly would be a further negative in terms of the global economic outlook. I mean, at the moment, we can only make our assessments based on the decisions that have been made and announced so far. But if further decisions in the same directions will be made down the track, then of course we would have to revise our assessments. But on the flip side, I mean, there's also positive opportunity. If countries around the world decide to work together to resolve some of these issues, in a better, more efficient way, not relying on tariffs and other trade restrictive measures, there could also be a positive impact on the global economic outlook.
Well, one positive has been the Europeans, and they've been energised on the policy front. They're willing to spend more on defence and infrastructure, and perhaps we can finish the conversation there. That view, that move by the Europeans has been widely celebrated. Can we finish on some words of caution for them? Do you have any?
Well, look, I mean, as a matter of general principle, investment, increased investment in infrastructure, in particular, increased investment in productivity enhancing infrastructure, is a good thing and is an important part of the overall increase in international competitiveness, and it should be part of a broader plan. But of course, in the end, it's all a matter of what is fiscally affordable and fiscally sustainable as well. And part of our advice to countries around the world, including in Europe, is to keep an eye on debt sustainability and on the need to rebuild fiscal buffers and fiscal resilience.
Mathias, enjoyed the conversation. Great piece. It came out early this week. I'm going to give it a good read a little bit later on. Mathias Corman there, the OECD Secretary General. In the summary page at the very bottom, they say higher government spending on defence could also support growth in the near term, but potentially add to longer-term fiscal pressures. Now, that might not apply to Germany, but for Europe as a whole, got to ask some serious questions. There's been way too much happy talk and groupthink regarding the investment and defence push by the Germans. And I understand why. It's something a lot of people have been calling for a long, long time. But we've got to ask some serious questions as well about what might go wrong.
Yeah, especially at a time where this is over 10 years that you're seeing almost €1 trillion of spending being deployed. You have to imagine what this means for spreads, what this means for the peripheral countries that might not have the same capacity to borrow that maybe Germany does. But also, seriously, how much can this actually boost an economy that's dealing structurally with some challenges and being between China and the United States?
Questions on the foreign policy front as well. You've basically got the Europeans communicating very transparently that in the future we will have our own defence. We will have a massive defence force, and this is how much we're willing to expend. But in the meantime, we don't have it, and we don't have the goods to secure anytime soon, because you're going to have to build these things. You can't buy them overnight. And the Russians are going to be listening very, very carefully, and I imagine calibrating their response to that accordingly.
And whether or not it's Europe building up their defenses, it all comes back to the United States. In the near term, it's backed up by the U.S. In the long term, even if you're spending more on defense, besides a select few like Rheinmetall, you're going to be buying weapons from USA.
A lot to think about. Equity futures right now in the S&P just about negative by 0.1%, with an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. U.S. Defense Secretary Pete Hegseth says that strikes on Houthi militants in Yemen will be unrelenting until the group stops attacking ships in the Red Sea. Donald Trump ordered a new wave of airstrikes over the weekend. Hegseth said that the latest strikes are also a warning to Iran, which backs the Houthis. The Vatican released the first images of Pope Francis in the hospital since he began treatment for double pneumonia last month. In its latest medical update over the weekend, the Vatican says that the Pope is gradually improving and using less mechanical ventilation to help his breathing. Fashion retailer Forever 21 has filed for Chapter 11 bankruptcy. The company has assets of $100 to $500 million and liabilities of $1 to $10 billion. It said in a press release that it would wind down its U.S. operations while pursuing a going concern transaction or a sale of some or all of its assets. That's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. I'm next on the programme, a healthy correction.
Corrections are healthy, they're normal. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
I'm next on the programme. We'll get the view from JPMorgan. Sam Zief joins us in just a moment from New York. This is Bloomberg. Equity futures on the S&P negative just a touch here, down by 0.2% on the S&P 500. In the equity market, 4 consecutive weeks of declines, the longest weekly losing streak going back to August of last year. Don't forget Friday, though, a really strong finish to the week. The biggest daily gain on the S&P of the year so far. No positive follow-through. We're down by 0.2. And the bond market down by 2 basis points. The 10-year 4.29. Later on this morning, US retail sales. The next stop for this market, 8:30 Eastern Time, about 41 minutes from now. And the surveillance this morning, a healthy correction.
Corrections are healthy. They're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
So here's the latest this morning. The White House isn't blinking as trade tariff policies erode market-based US exceptionalism. Sam Zief of JPMorgan writing, we think this is more of a growth scare than a true slowdown. But that's where you could get another leg weaker in the US dollar. Sam joins us now for more. Sam, good morning. Welcome to the programme.
Good morning. Thanks so much.
Let's talk about the policies and how the market has responded to them. The policies themselves aren't that surprising. Tariffs. We were promised tariffs. We've got tariffs. The surprising element to this is how the FX market has responded to said tariffs. What explains that, do you think?
I think the operative word here is uncertainty. So if you think about it, coming into the year, people expected tariffs, but the amount of uncertainty around U.S. economic policy is greater than I think many were thinking, and that's starting to weigh on the soft data in the U.S., weigh on sentiment, weigh on business confidence, which is starting to introduce a little bit of downside risks to the U.S. outlook. At the same time, you have uncertainty over, let's say, the U.S. commitment to global security, at least if you're from a European perspective. And that's now sparking large fiscal stimulus in Europe, largely focused on defense, but infrastructure as well. And that's starting to raise expectations for fiscal stimulus and growth in the Eurozone. And so you have uncertainty, but if you combine the two, you're starting to narrow that gap between U.S. growth and rates and the rest of the world. And that's what the market is starting to price in, with the dollar starting to weaken year to date.
There's an argument being made that right now the dollar weakness and the euro strength is only pricing in the fiscal spending in Europe, not necessarily the weakness in U.S. growth. Do you agree with that?
I would. I'd say the market has gone a long way to pricing optimism in Europe. Think about the rate moves we've had, the kind of neutral rate estimation in the market's eyes for the euro area, where the ECB's terminal rate is. Those are both increased 25 to 50 basis points, really to the upper end of, I'd say, accepted ranges. You're not pricing in a lot of growth pessimism in the U.S. You've taken out some of the optimism from earlier this year, but growth pessimism, the Fed's still only priced to cut to 3.5%. The 10-year yield is around 4.25%. Think about last fall, last summer, when you had the Somme rule triggered, a lot of recession fears in the U.S. economy. 10-year yield was 100 basis points lower than it is today almost. You had the Fed price to cut 50 to 75 basis points more than it currently is. So that's where that leg of extra dollar weakness, if the market was going to price that type of slowdown in the U.S., that's where the next leg would come from.
It is highly unusual to see the dollar weaken at a time that's risk off, at a time when you see equities also losing value and there is uncertainty economically globally. A lot of people have raised a question, is this the beginning of a new shift, of a paradigm shift where suddenly it's a reversal of the trend we've seen into the dollar over the past decade? Do you agree? Do you think that that's what this is?
Well, where that risk off has been concentrated has been in U.S. equities and in U.S. tech, which has been the main dominant driver, let's say, for the last 10 years. I would say that you're starting to see a little bit of a shift in the dollar's relationship with risk assets. If it continues, you're going to lose one of those things that's really built up these big overweights to U.S. assets. So think about it. Global investors for the last 5 to 10 years or even longer have built up big overweights to U.S. assets because they're safe, they're liquid, the dollar provides a natural hedge when there's a risk-off environment. U.S. tech has been the main outperformer. If the market starts to question a few of those, there's a very, very large capital shifts that can occur. We're not really starting to see signs of that, but I think that's something we're watching really closely. Hard to get data on it, but it's really important to just note that even just small amounts of shifts, a couple percentage points among these global investors, is hundreds of billions of dollars.
We do know Trump hates trade deficits. If there's a weaker dollar, potentially that can cut into that. Do you think a weaker dollar is actually welcomed by this administration?
I'd say the weaker dollar is one thing that can help rebalance trade. It's not the only thing, right? And so it's something that we're trying to pay attention to. Like usually on most models, you would need a very large depreciation of the dollar to be large, persistent, stay in place for a large period of time to rebalance global trade. I don't presume to know what the administration is exactly trying to do, but it's a reason that we're starting in the private bank to think about the right types of diversification across asset classes and across geographies. And so trying to take the market at face value, respect the risks, and invest globally.
Right type of diversification, meaning you're buying more gold?
Definitely buying more gold. That's definitely the first destination of kind of global investors that are looking for alternatives to U.S. dollars, but also investing globally, right? And making sure that we're not ignoring other geographies that are starting to see a pickup in momentum. And also, of course, just investing across asset classes. So not just in U.S. equities, but looking at bonds as well.
This has been a sales pitch for the best part of a decade. You've got to buy international.
Yep.
Are people finally buying? Do you feel that capitulation?
I won't call it capitulation yet, but it's definitely getting more conversations in our internal investment committee meetings and everywhere else as well. Rather than starting to shift all of your U.S. allocation into global, a recognition that this is why you have it. It hasn't been fun. It's been a detractor in some portfolios. We hear it. Everybody hears it. But this is why you have it for times like this.
The ECB's not having fun. Should we finish on that? I like Luis de Guindos, by the way, the vice president. He's a very nice guy.
You're going to bring
Charming
this back
man.
up.
Of course.
All right, carry on.
He says it's the most uncertain time, even with the pandemic in mind. He thinks it's more uncertain now than the pandemic. What's your view on that?
I was listening before. I'm going to give him a little bit of defense here, which is to say that for a central bank, it is a tough environment, the current one, because you're getting some downside growth risks. Inflation is still above target. Inflation expectations are always fickle, so you don't want to necessarily ease too early, let's say. And so I think from a central banker perspective, it is uncertain. You're not exactly sure what to do. Pandemic, much larger shock than anything we're living from today, but it was very clear what to do. You ease policy, you ease aggressively. I'm going to cut him some slack and say that's what he's talking about.
Does Chairman Powell need to confront the same thing on Wednesday?
I think they're dealing with the same uncertainty, right? And I do think that what the Fed is basically saying is we're going to stay on hold for a little while. We're watching this. Let's see what the policies actually end up being. Let's see what the data tell us to do. But a big reason that we think that actually fixed income, even U.S. dollar fixed income, is looking quite interesting from an asymmetric return profile is because at worst, the Fed stays on hold for a while. You get the yield that's written on the tin. It's hard to imagine a big backup in yields with downside growth risks. But if something does materialize that's much worse and the Fed does have to ease, they'll provide protection in a portfolio.
Sam, appreciate it. Sam Zief there of JPMorgan. Didn't provide much protection last week, did they?
No.
Or the last couple of weeks, for that matter.
Because of concerns about inflation that remain sticky. I just want to say that was a much better defense of Luis de Guindos. And frankly, it's not saying that this shock is the same. I'm not saying that, some of these policies are us burrowing into our homes and a camera and our kids on the couch.
They say it was the obvious thing to do back then. I just don't think we've paid the price for it yet. That's all.
Could be. I think that you're right.
That's all. Up next on the programme, Samana of Wells Fargo, Tom Forte of Maxim Group, Neil Dutta of Renmac, Collin of Charles Schwab. From New York City, the third hour of Bloomberg Surveillance. Up next.
The market is forward-looking, but I'm not sure we are right now forward-looking enough to look through all the weakness that is going to come in the economic data.
I think it's time for some selective buying in the U.S.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
Corrections end on bad news. They don't end on good news.
What you'll probably see in here, the market's trying to find a bottom. There will be a bounce.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
So the opening bell about 90 minutes away as we kick off the third hour of Bloomberg Surveillance. Your scores look like this. Equity futures on the S&P 500 softer by a little more than 0.25%. On the Nasdaq 100, softer also, weaker, lower, negative by 0.1%. And the underperformance comes from the small caps, the Russell. This can all change in about 29 minutes' time when we get US retail sales, another read on the US consumer, and the last big read going into the Federal Reserve 2 days away.
It's going to be important to tell whether the deceleration does continue. We did see last month this deceleration, a decline of 0.9%. The expectation is for an increase. If you do get a deceleration, how much does that just turbocharge some of the concerns about a growth slowdown? In the face of, yes, uncertainty,
but also already slowing growth. And that's something Neil Dutta has been really clear on.
And Neil's talked about anxiety over unemployment starting to rise, consumer sentiment starting to drop. And some of the companies in corporate America, I'm thinking of Delta Airlines in the last week, starting to tell you that in the middle of February, spending started to stall for some consumers and for some businesses alike.
Kohl's, Dick's Sporting Goods, the airlines are starting to show you that consumers are pushing back. And of course, the Michigan survey on Friday talking about consumers, talking about the uncertainty of policy out of Washington, D.C. Long-term inflation expectations hitting a 32-year high because of those tariff concerns. When you think about retail sales, when it comes to tariffs, and you talked about this earlier, Lisa, you think people front load and are buying a lot right now because they're concerned of prices going up? Or has the consumer actually been hit? They're worried about maybe losing their job and a lot of anxiety, and they are deciding that they're not going to go out and spend.
There was a study highlighted by the Financial Times by Retail Next, which is a consultancy, that said that footfall in U.S. stores fell 4.3% in the early weeks of March. So people are saying that it's more of the latter and not the former in terms of people front loading, especially because they're already seeing prices creep up in certain places and they are already feeling the hit from some of that uncertainty.
Step up Chairman Powell. So Chairman Powell goes into this news conference on Wednesday with some new forecasts, and we'll see what we get in those forecasts. Some people anticipating lower growth forecasts, but what will happen with the outlook for inflation? And this is a really curious time because everyone's talking about the prospect of higher prices. At the same time, energy prices are dropping. That's pretty unusual. That's not something we're used to.
And you've made this point. It is a correct one. Why are they dropping? Are they dropping because of supply or are they dropping because of demand? And the answer is both. The expectation for OPEC to actually increase some of their production and ongoing pumping at the same time that demand is expected to slow. We see the projections coming out that is the case. Again, this goes back to the difficulty of a stagflation-like playbook. And that is what I think a lot of people are trying to wrap their heads around. How long can inflation remain sticky if growth and demand truly is falling?
The Federal Reserve decision 2 days away. Equity futures right now down by a third of 1%. That data is just around the corner. US retail sales 8:30 Eastern Time. Coming up on the program, we'll catch up with Samana of Wells Fargo as the White House calls the stock correction healthy. Tom Forte of Maxim with Apple down double digits so far this month, and Neil Dutta of Renmark reacting to that economic data later this hour. We begin this hour with stocks looking to snap the longest weekly losing streak going back to August. Samana of Wells Fargo staying constructive. We expect stock prices to march higher by year end, driven primarily by earnings growth that should broaden to more cyclically oriented areas of the market. Samir joins us now for more. Samir, welcome to the program, sir. I have to say a key feature of your outlook is still US outperformance, US economic resilience. Now, that was consensus at the start of the year. 2-3 months later, it's on the edge of contrarian. Samir, why are you sticking with the call?
Yeah, and I mean, look, I think it has just as much to do with the international side as it does the U.S. side, right? I mean, if you look at, kind of what's happened with Chinese equities over the past, I'll just call it 5 to 10 years, there's been these false dawns, and they happen. And, the way we've always likened it is the Chinese tend to kind of drive a car with, one foot on the accelerator, one foot on the brake as they go down the road. And the last tap was probably on the accelerator, but the next one could easily be on the brake. So you do want to be a little careful chasing performance there, and that's really been the driver for emerging market equities, where we remain unfavorable. On the developed side, same thing. Europe has had many kind of, times when it seemed like they were, moving towards greater cohesion, the valuations were cheap, and that we were finally going to kind of unlock that value. And then something happened in order to make kind of the political stuff, take a step backwards. So I really do think the U.S. still remains the cleanest story, and the administration really does want America to come first.
If these are false dawns abroad, potentially head fakes, what do you make of the dislocations we're seeing in big tech?
Yeah, so we also think big tech probably rebounds from here. Again, the multiples had probably gotten a little lofty. I think expectations had probably gotten a little bit lofty. I think anybody who thought that there wasn't going to be competition around AI and was surprised by DeepSeek probably wasn't doing their homework to begin with. And now that expectations have reset, I think tech looks really interesting at these levels.
Flows can take on a life of their own, Samir, and that's something we were just discussing with Sam Zief, this concern that given the fact that the dollar has weakened in tandem with big tech, it could prompt some rethink globally of whether the U.S. truly is a hedged story, whether you can buy using dollars that will rally if there is some sort of downturn and get that as sort of an offset. Do you see anything like that happening, or how concerned are you about some sort of global shift away from the U.S.?
I mean, we've always been kind of neutral on developed market equities, so we do want people to have a full allocation there. Interestingly, we think the dollar probably rallies from here. And, again, if you think that inflation is going to stay higher, it means the Fed probably has less room to cut than some of the other central banks, which, again, should be supportive of the dollar. And then if you see tech kind of starting to bottom out, as we think it will, we think some of that hot money, which, has chased returns abroad, probably comes back home.
So what do you reject that we're hearing about, or the market is sniffing out about slowing growth that we heard particularly last week from the airlines? Why is that not something that really is a warning sign to you?
It probably is. And look, it's probably a warning sign on the consumer side. So, the areas that we like tend to be more on the manufacturing side. We like industrials. We like energy. Refining spreads are finally starting to kind of perk up. We like financials. The curve has, finally, gotten to positive territory. So we think they'll do okay, although, there could be some credit quality concerns if there's a bigger economic slowdown, not in our base case. And then we like comm services. So when you look at kind of the areas that we favor, along with large caps and mid caps in the U.S., it's a very high quality portfolio. So this is not a swing for the fences type of portfolio. Where I guess maybe the market has gotten things wrong is the consumer's been tapped for years now. I mean, I remember just day after day, week after week, we would just talk about, hey, look, when does the low-end consumer, just finally tap out and the high-end consumer finally, kind of hit the skids? And I think some of that has been a long time coming, but some of it's probably precipitated by the tariffs.
When it comes to the tariffs and the policy right now, you think that Trump is going to have a targeted tariff approach. Why?
I mean, because he said as much, right? I mean, again, I think he wants to kind of start with shock and awe, and then I think they'll probably settle into something that, is, in his mind, probably what maybe kind of cures the ills that he sees, and then they'll move on. They'll move on to deregulation. They'll move on to taxes. Like, I don't think we'll be talking about tariffs to this extent at the end of 2025.
When it comes to them moving on, we haven't heard a lot about deregulation, and when it comes to the tax cuts, Bob Elliott, our guest earlier today, said basically it's just extension of TCJA, which is the current law right now. Is that enough to really boost excitement in this market?
I think I come back again to, all right, what's your alternative, right? You've got long rates kind of in that 4 to 4.5% range, as I've been, telling people, look, after tax, after inflation, you're almost left with nothing on the Treasury curve. If you move out to corporates or high yield, now you're taking some of the same risks. I would argue, I would take high quality equities probably over high yield at this point, and you at least get, still a pretty solid kind of 5% earnings yield. Then you throw in the buybacks, you throw in the dividends. We still think equities probably offer kind of, low teens type returns. Now, again, it does come with some risk, but we think after the pullback, you've already taken a good bit of the discounting kind of out of the equation.
Samir, how much protection are Treasuries providing in a portfolio right now, given the fact that, just to take score for the month so far, we're down 5% on the S&P 500 and bond yields aren't dropping? They're doing the opposite now. That wasn't the way we started the year. It wasn't the way we started this administration, but there has been a subtle shift over the last 2 weeks, and I'd love your thoughts from you and the team.
Yeah, and that's just it, right? Is that, look, if inflation is not going away, which has been our base case for some time, we've been on the north end of consensus for as far back as I can remember. We just didn't think inflation was going away. If anything, we continue to worry very much about a second wave of inflation, right? Especially if, the tariffs cause wages to start kind of perking up, and then there's, again, to call it that upward spiral. Not our base case, but that's the side that the risks are coming in at. And so what history tells you, and even recent history tells you, is when you have inflation as the problem front and center, stocks and bonds can both struggle at the same time, which is kind of what you're seeing now. And that's why I think gold's doing a little bit better. Commodities, where we're favorable, is doing a little bit better. You may want to sneak a little bit of that money, as I mentioned, to the developed market equities. So I think it's okay to have some diversification in that type of scenario. But yeah, I think it's going to be really tough for bonds to outperform from here.
Samir, it sounds like you prefer the U.S. You still do think that it's the cleanest shirt and whatever cliche you'd like to put out there. At the same time, it sounds like you don't expect big returns this year. Is that correct?
I mean, from current levels, we do. I think our year-end target for the S&P is 6,600. So, if you throw in the dividend yield, that is, again, kind of, mid-teens type returns into year-end. If you start to think out into the first quarter of next year, now maybe you're talking high teens. We just upgraded mid-caps to favorable. We think they could do, as much, if not better than that. So, I guess what I would tell investors is don't wait for the narrative to shift, right? Right now, there's this really negative narrative around tariffs, around inflation not going away, around a growth slowdown. I promise you it'll change as we get into the summer months. And at that point, the markets will respond first and investors will find themselves trying to kind of catch up to where markets are going.
Samir, appreciate the clarity on your view from you and the team. Thank you, sir. Samir Samana there of Wells Fargo. A key feature of their point has been US economic leadership, and that was very, very consensus at the start of 2025. And as we work our way through the year, it's on the edge of contrarian now.
I would argue it is contrarian to say that the U.S. is going to be the outperformer, that you've got, in the mid-teens in terms of outperformance for U.S. equities at a time where big tech is supposed to rebound. Other people, whether it's Stuart Kaiser, whether it's Lori Calvasina, we don't know. These signals are getting a little confusing.
Let's go to the forecast from the OECD. So they've got US growth down for 2025 at 2.2%. Eurozone GDP growth projected to be about 1% in 2025. Now, in terms of levels, you'll get the outperformance for the US versus, say, Europe. Probably, most likely. As a lot of people always say on this programme, what the market's interested in is better or worse. And things in the United States, based on projections, are worse than people thought they would be only a few months ago.
And they are better than they thought that they would be elsewhere when you have the promise of fiscal spending. We can't emphasize it enough. And I think you put it really well. This idea, have we paid for some of the fiscal bazooka that we engaged with during the pandemic? And is now the time where you're going to have to ultimately pay for it? And if you don't, you're going to get penalized in the debt market. It is an interesting time coming off one of the biggest dislocations we've seen in a long time.
Feels like Secretary Besson's the only guy out there saying, yes, we need to pay the price for this. And it means a detox.
Well, other people say that there is a price to pay for it, but we don't want to pay it. At the same time, I think the issue isn't that there is not a crisis. I think a lot of people agree with that. It's what is the cohesive plan to get there? Are we cutting enough to actually make a dent when it comes to reducing the deficit?
Looking potentially at a major realignment across several dimensions. Equity futures right now on the S&P slightly softer. We're down 1/3%. Big economic data points 17 minutes away. US retail sales just around the corner. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The U.S. Mid-Atlantic is on alert as a powerful storm system sweeps over the region. The Storm Prediction Center said more than 50 million people from western New York to central Florida were in the track of the storm. This comes after at least 36 people were killed across 6 states when a massive storm system moved across the South and Midwest last week. President Trump may be raising the possibility of new investigations into the January 6th committee. In a Truth Social post, Trump declared President Biden's pardons for the committee members void because Biden signed them with an auto pen. Last year, a federal appeals court found that a pardon doesn't have to be even in writing. And March Madness is upon us. The Auburn Tigers were named the men's top seed with Duke, Houston, and Florida also getting named as number 1 seeds in their conferences. The tournament begins tomorrow with the first 4 games tipping off in Dayton, Ohio, ahead of the main bracket action on Thursday. And that's your brief, John.
Danny, thank you. I just wish I had a snapshot of Bramo's face just then. Not doing your bracket, Lisa.
Well, no. I just feel like it's, sports roulette.
All right, that's a no. Okay. Up next, the Morning Calls Plus. Tom Forte of Maxim Group on how Apple can bounce back from its double-digit drop so far this month. A conversation up next, live from New York. You're watching Bloomberg TV. Equity futures here just a little bit softer. We're down by 1/3%. On the Nasdaq 100, down by 2. On a Russell, negative by 0.6. That's the price action. Let's get you some morning calls. First up, MoffettNathanson upgrading Netflix to buy, calling its ability to monetize engagement underappreciated. That stock up by 1.2%. Your second call from JPMorgan upgrading Norwegian Cruise Line to overweight, seeing no change to demand trends despite emerging consumer concerns. Interesting one, that. Goes against the grain with the airlines, that's for sure. That stock is up by 4% in early trading. And finally, Mizuho lowering its price target on Tesla to $430, expecting February sales to underperform in several key regions. What's that, horses, barn doors and all that stuff? Stock is down by 1.2%.
It's just, I remember how we used to not care about deliveries with Tesla.
Yes.
It was a belief stock. It was a sort of dream stock. And now it's both.
The bulls will tell you it's still a story stock, right?
Yeah.
It's the future. It's away from what they're going to do with EVs.
Yeah, but even Dan Ives kind of moving away from that and saying it is the moment of truth. Either come or don't come back to Tesla or else stay at Doge, and maybe we're not going to have such a great go of it.
Stock is down in the pre-market by 1.2%. Let's stick with the Mag 7 names. Apple shares under pressure, down nearly 15% so far this year, as slow revenue growth and uncertainty around its AI offerings weigh on the stock. Tom Forte of Maxim Group has a hold rating on the stock with a 215 price target, noting its AI smartphone is a potential catalyst. Tom joins us now for more. Tom, welcome to the programme. Always good to get your thoughts on the name. Let's talk about Apple right now. What do you think is behind the recent weakness over the last few weeks?
Yeah, so I'm actually encouraged because I think for the first time in a long time, some of the risks for Apple are starting to get priced into the shares. When you think about, are we in a global trade war, or are we on the verge of a global trade war when it comes to Trump's tariff policies? And in particular, you think about a trade war with China, which is a high teens % of sales, and still where Apple manufactures most of their devices. I'm actually encouraged that the stock's starting to price in some of the risk.
So, Tom, when we go into the next earnings release, are you expecting some weakness in China and some weakness that's already priced? Because we did drop another 11%, close to 11% last week alone.
Double-digit declines in China in the December quarter. And the concern would be that a prolonged trade war with China would inspire more consumers in China to buy from Huawei and not from Apple. Add to that the fact that Apple's been unable to roll out their AI feature set in China, and I think you're going to see continued weakness there.
So, Tom, what would make you actually be enthusiastic about this stock, given that there are a lot of fundamental challenges, and you're encouraged by a 14% drawdown so far this year, but not really changing your hold rating?
Yeah, so Lisa, what would get me more excited is Apple still generates a ton of free cash flow. And generally speaking, when they report the March quarter, they update their returning capital to shareholders policy. So I think lost in the shuffle on the Trump tariff policy is Trump's tax plan. And when you think about Apple, and they pointed this out when they announced their $500 billion investment in the U.S., that they're one of the largest taxpayers in the U.S., and a prolonged period of lower tax rates means more free cash flow and a greater opportunity to buy back stock. That gets me, excited, I guess.
So later this year, you could see, if those tax cuts get extended, that there could be some sort of stock repurchasing that maybe, you guess, could get you excited or move away from a hold. What's your concern level about some sort of tit for tat between the U.S. and China, roping Apple into it and make Tim Cook have to choose in a way that the ultimate diplomat just hasn't had to do yet?
So historically, as you pointed out, Lisa, he is the ultimate diplomat, CEO by day and diplomat by night. Does an amazing job balancing the company's relationship between the two countries. Elon probably second best with Tesla. What would get me more excited is evidence that that there is an upgrade cycle as it pertains to AI. We haven't had that evidence to date, given that they rolled out the new hardware the 16th of September, and they've been rolling out the software piecemeal with the AI feature set, and you haven't seen very good Apple iPhone sales. So maybe as the year progresses, you start to see evidence of an upgrade cycle, or at least better than what we're expecting right now.
Tom, let's think about the backdrop for this decline, particularly over the last 2 weeks or so, and for that matter, over the last several months. We've seen a major sentiment shift away from the United States to Europe to China. And with that, multiples have had to come down. And Tom, I just wondering if you can go beyond just a single name coverage just for a moment, just indulge me. Do you think there is a possibility here that perhaps the scarring from several events over the last couple of months could be long-lasting, that maybe the willingness of investors to pay up for US equity names, particularly US tech and major tech names, that willingness might not be there through the rest of this year?
So the argument against that, Jonathan, would be that the US has been the source of most of the globe's major tech companies. Yes, you have Alibaba, Tencent, and some other giants in China, but you're talking about Apple, Amazon, Meta, Facebook. Sorry, Meta and Facebook, same thing, Google. So the innovations come out of the US, the multiples, I think, will follow the innovation, and there's reason to believe long-term that the US will remain the epicenter for tech and for stocks in general.
I guess what I'm getting at, Tom, is how much of this is really about tariffs? How much of this is really about still dealing with the fallout from the DeepSeek revelation from the back end of January?
Well, the problem, Jonathan, with the DeepSeek revelation is that every major US tech firm basically reaffirmed that they're going to spend a ton of money advancing their AI efforts. So I think that we should expect there to be competition, especially from China, for AI. Let's see how Amazon, Apple, and others ramp their AI efforts. And if the CapEx spending is worthwhile, I definitely believe for Amazon it will be. So let's see how things play out.
So what do you have to see to actually raise it to a buy at a time where potentially there are all of these headwinds, there is competition, there is the upgrade cycle, and at a certain point you also just have structurally higher rates potentially that could impact valuations?
So it is possible, Lisa, that the stock just trades down lower, so there's more upside to our price target. So, the risks getting priced in to a greater extent. Love to see signs of improving sales in iPhone. But again, they generate a ton of free cash flow. We haven't talked at all about their services story. That's very compelling. That's where all the upside came in the December quarter. They recently added Apple TV to Android devices. So I think the services story is quite good still, higher margin than the hardware. So there are things to like. I just would like the shares to get priced in a little more risk.
There's also a concern longer term, and this is something that Peter Scheer of Academy Securities raised over the weekend, that as the trade wars drag out, that Americana brands, the ones that really represent the United States, will get penalized in foreign sales, akin to what we've seen maybe in Tesla anecdotally. Do you believe that that is something that could pose a challenge for the likes of Apple, which has traditionally been associated with Americana?
The answer is absolutely. And really the worst example, Lisa, is the Canadians taking the American liquor off the shelves, essentially. So yes, I do think that a prolonged trade war, nationalism, consumers in China buying from Huawei instead of Apple, brands that are associated with the U.S., even though they are global brands like Apple, having negative views outside the U.S. on a prolonged trade war, that's certainly a risk.
Hey, Tom, appreciate it, as always, to get some clarity from you, sir. Tom Forte there of Maxim Group on Apple. Apple down by close to 11% last week. Pretty ugly week at the moment. In a moment, we'll get US retail sales. And I think a big question for the likes of Neil Dutta of Renmac. If you have an iPhone, which is a wonderful product, and it lasts, and you don't need to upgrade it every single year, and anxiety about employment is going up, and confidence about the economy is going down, are you going to upgrade for an iPhone anytime soon?
The answer has been for a long time, based on the Jonathan Ferro index, that not so much. And that really is going to be the key tell at a time where it's $1,000. And why bother?
In a wait-and-see economy, why would you rush?
Yeah, I mean, that's probably...
In a wait-and-see. Show me the new products. Show me that AI. Show me why it's going to change my life.
You
and
wouldn't
maybe
really... What do you want it to do?
Life.
Cook?
Battery life.
I'm a very simple man. It's the battery life. Retail sales. Up next from New York. This is Bloomberg. "25 seconds away from a much-anticipated US retail sales print. Mike McKee's going to break that down in just a moment. Your scores going into it look like this. Negative by 1/3% on the S&P, down by 1/10 on the Nasdaq 100. In the bond market, 2-year, 10-year, 30-year. Your yield curve shaping up as follows. The 10-year this morning, your yield is down 2 or 3 basis points. The 10-year, 428.51. With that economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, the economic data is the hard data people have been looking for, and it is worse than anticipated. We had a question about whether the hard data would follow the soft down. Retail sales on a headline basis up just 0.2%. Ex-autos up 0.3%, and ex-autos and gasoline up 0.5%. A retail sales control group is reasonably strong, though, up 1% after a negative 0.8% drop in the month before. We'll take a look at what the movers were in just a moment. The Empire Manufacturing Index, another soft data, comes in terrible. Down 26 points to -20, with new orders, shipments, employment, and hours worked all falling. Prices paid rise 5 points to 44.9. That's the highest level in more than 2 years. Optimism about business activity in the future falls 10 points after dropping 15 points last month. So it looks like at this point, people are not confident in the future, and to a certain extent, they're spending less.
Michael McKee, let's put it this way. Some conflicting data, some tension, a tug of war between the soft data and the hard data. And that tension continues. So I'll just give you a snapshot of what the bond market is doing in response to it. Initially going into this print, yields were lower by 2 to 3 basis points across the curve. We erased some of that move, now higher on the front end by a single basis point, just north of 4%. In the equity market, I'm sure for many of you, you don't know what to do with this. You're not alone. Equity futures just about unchanged on the session, down by 0.2%. Headline retail sales month under month, a downside surprise of 0.2% against an estimate of 0.6%, but the control group, a punchy 1% against an estimate of 0.4%. And then you've got a really ugly Empire Manufacturing read in the mix as well for the month of March. So, Lisa, put that all together. What have you got?
You basically have a situation that's not weakening fast enough for the Federal Reserve to cut rates in an imminent way, but you have weakening growth and, as Mike was talking about with Empire Manufacturing, ongoing concerns about price pressures, even with reduced demand. This is not what you want to see. I want to point out that revisions were all to the downside when it comes to retail sales for the prior month. So not weakening quickly enough to necessarily warrant an emergency rate cut of any sort, but definitely on the weaker side.
Mike McKee, just want a quick explanation. I know you're going through the details as we speak. What explains the downside surprise on headline versus the outperformance, the upside surprise on a control group?
Well, we had a big drop in motor vehicles and parts, autos down 0.6%, and a 1% drop in gasoline prices. So that's weighing on the headline. The only thing that's really good, though, in the report is non-store retailers, e-commerce, up 2.4%. But food services and drinking places, sporting goods, clothing stores, health and personal care stores, everything else is down during the month. So it is not a very good report overall. We stayed home, I guess, in February. Maybe it was the bad weather and ordered stuff instead of going out and buying.
Mike McKee on the latest. Neil Dutta joins us now to extend the conversation. Neil Dutta of Renmac. Neil, welcome to the programme, sir. You've noted the soft data, the anxiety over employment specifically. I just want your thoughts initially on retail sales. Do those two things stack up?
Well, I mean, the retail sales data was basically an online story. I mean, last month, a lot of the weakness that people didn't foresee was a function of online retail. And this month, a lot of the strength that people see was a function of online retail. So that kind of just swung around. If you take that out, the underlying story is still weaker. I think it's interesting that food services and drinking places, basically restaurants are down 3 months in a row, or down, over the last 3 months, and pretty meaningfully over that period. I mean, that's sort of a bread and butter type of discretionary purchase. If you're not feeling good, you're not going to go out to eat. And that's exactly what's been happening.
Neil, you've been clear about how this weakening trend has been in place for quite a while, that really since late last year, you could start to see it in the data. And this is part of the economic cycle as much as anything else, if not more. I am wondering if you're surprised by the pace of some of the deterioration, especially in light of the pressure that increasingly is being put on the Fed not to cut rates because of inflation expectations.
Well, I mean, I don't think there's a smoking gun yet in the hard data. I mean, I want to be clear about that. There's no sign of collapse. There's no real discontinuity in the hard data. I mean, that's a classic Greenspan sort of tell for trying to figure out when, if we're in a recession or going into one. But you clearly see weakness in, soft measures of economic activity. And obviously, there's been a fairly rapid speed in terms of the weakness in consumer sentiment. As an example, the March Empire data sort of the same thing. Obviously, if you're doing tariffs, I mean, that's going to weigh on the goods sector, disproportionately, and you're seeing that. But you've yet to see that really translate into hard measures of activity. And I think at some level, Lisa, I mean, the fact that the economy, I mean, residential investment's been quite sluggish. A lot of the cyclical areas, manufacturing's been quite sluggish. So if these cyclical areas have been relatively soft to begin with, it mitigates some of the downside, because if you're sort of bouncing along the bottom, it's hard to go further down into the basement.
One thing that you've laid out, Neil, and I thought it was really profound, especially in your conversation with Paul Krugman over the weekend, was the degree to which some people are underestimating the amount of state and local funding that's being cut right now, and how some of the federal cuts might look really small on kind of a national spending level. But when you start to get those cuts at state and local levels, that's where it's going to bite more significantly. I'm wondering, how quickly are we starting to see some of those cuts filter into some of the economic data that we're getting out, like spending, like consumer confidence?
Well, I think the area to watch is really state and local government employment. I mean, that had been a steady tailwind for jobs growth over the last year or so, and that's shifting into a much lower gear. Remember, state and local governments were adding 30 basis points of GDP growth, and that's probably poised to go to zero, maybe even slightly negative this year. That's what we're seeing in the upcoming fiscal year. States have exhausted their pandemic relief money, and that's already started to weigh on sort of public sector construction spending. I think employment's going to be the next leg of that.
Neil, when it comes to this administration and their pain tolerance, over the weekend, Treasury Secretary Scott Bessent, someone I know you know well, said over the long term, if we have good tax policy, deregulation, energy security, then the markets will do great. But in the short term right now, the only policy we keep getting out of this administration is tariffs. What's their threshold for how painful they're willing to take what we're seeing in the financial markets and consumer sentiment?
Well, I don't know the level of the put. I mean, I just know that it's lower than where we are now. I mean, look, I do think it's more about what they're doing, not the uncertainty around what they're doing that's driving the markets. But, you and I have talked about this, Annmarie. Did people not know what they signed up for? I think what we're seeing is when Trump won, everyone knew that it was some combination of tax cuts, deregulation, and tariffs. But they bet on it in that order, which is why you saw expectations for growth, at least in the first and second quarter, go up after the election. But obviously, we see what the order is. And any day that they're not talking about tax cuts and deregulation is a day they're talking about tariffs. And the signaling of that means that they're pursuing a lot of growth unfriendly initiatives first.
Neil, why do you think there was this consensus around the sequencing? Because it's very clear, if you understand Washington, that the only lever Donald Trump could pull on his own when he got into office was unilaterally tariffs.
Well, yeah, I mean, I don't know, Annmarie. Maybe you should get into the private sector forecasting business, because I think that was a great call. But look, I mean, not only that, I mean, any legislation was going to be a very, very tall lift as well, as you know, because the Congress was so thinly divided. I mean, I think at some level, because it's going to take them longer to get some of this tax stuff through the finish line, that's probably why one reason why they are front loading the tariff agenda.
Neil, I haven't watched it yet, but people want to know, is Krugman Dutta going to become a regular thing? Do we get a second series?
You'd have to ask Paul, but it was quite the honor to be on with him.
Neil, appreciate the input as always, sir. Neil Dutta of Renmac. Did you watch that over the weekend?
I did. You saw Neil almost fanboy a little bit in the beginning. Am I right?
Well, I mean, honestly, I understand it. It was a really interesting conversation.
Mutual respect.
That's what I was going to say.
They should come on the program together.
We should make that happen. Got to deal with something else first, though. Need to talk about the economic data. Mike McKee's back with us. Got a busy week ahead as well, Mike. That was the last big read on the US consumer going into this Federal Reserve meeting on Wednesday. When you piece it all together, Mike, what's the review? What's the conclusion of where we are right now?
Well, we seem to be on a slowing trend. The question is, how fast do we continue to slow, and how far down do we go? We get a lot of data this week that will add to the overall impressions that the Fed and the markets have after the dismal Empire number and the poor retail sales number. Tomorrow we get housing starts, import prices, which feed into that PCE number, the last piece of that, and industrial production. That's going to be interesting. What's happening in the factory sector at this point, given the consumer sector seems to be weakening? Wednesday, obviously, the Fed meeting and Jay Powell's press conference. And then Thursday, claims, we're watching that, Philly Fed and existing home sales. The more important number, though, for the markets might be coming out later this morning. We get the first update of the Atlanta Fed's GDP now in about 2 weeks since they put out that negative 2.4% figure. A lot of people don't realize this is just cumulative adding up what we know for the moment, not a forecast, but it did influence a lot of people's views of the economy. And today they're going to update it with the latest data, so we'll see how that moves.
Look out for that. Like the Green as well, Mike. Should have done the same thing. St. Patrick's Day. Happy St. Patrick's Day to you all out there, particularly the Irish here in New York City getting ready for that big parade. Terrible weather for it.
Yeah, well,
isn't it?
Yeah, but, that's par for the course. They'll still be happy.
That's part of being a New Yorker,
exactly.
Is it, Brownlow?
Yeah,
nice,
I know,
all right.
so Irish.
Collin Martin and Charles Schwab with us now for more. Collin, good morning.
Morning.
Good to see you, sir. If you're in the bond market right now, I think you want a better understanding of whether you need to be focused on growth, inflation, or both.
I think both. I mean, that's really what it comes down to. The risks are kind of balanced to both right now. I don't think we're going to get too many insights this Wednesday about where the Fed is tilted. I'm sure they're going to keep it pretty open-ended. I think for now, the growth concerns appear to be more on the sentiment and consumer confidence, and we're still waiting for that hard data. Obviously, we got the number this morning. Looks like it was kind of mixed, a little soft on the headline, a little bit better on the control. So I think we'll need to start to see more hard data roll over before we get a little bit more concerned. So our guidance right now is we think ultimately the direction of interest rates is probably a little bit lower. But for now, we're not making a big bet about that because I think a lot of it does rely on the hard versus soft argument.
For much of this year, the bond market appeared to be more focused on downside risk to growth versus upside risk to inflation. Neil Dutta was with us just moments ago, and he's highlighted the anxiety that's rising around the labour market. And for that reason, I think economists at the moment say that should dampen any concerns around second-round effects from tariffs. If you're worried about your job, you're not going to your employer and asking for a raise. You're not going to see that get away from you. You should go to your employer and ask for a raise. I'm just throwing that out there. But anyway, that seems to be the conclusion right now. Is that the right conclusion?
I think so. The labor market is still relatively strong, but there's a but. That's kind of how I'm looking at it right now. Most of the data supports a relatively strong market. The unemployment rate's still relatively low. We're seeing employment gains, but they've slowed down. I think that's a big part. We've seen the participation rate tick down a little bit. JOLTS is kind of mixed. We saw a little tick up in quits data. That's something we look at about if you're asking for a raise, are you willing to move to another job? So that is something that's important, but you hit the nail on the head. If you're worried about your job and you have this anxiety about what's going to happen because of all the political uncertainty right now, what that translates to business from a high level, that's going to impact our spending habits. So I think that is important right now. Right now, things are looking pretty good, but there are pockets of weakness on the edges.
So how can inflation continue if people are concerned about spending? And it sounds like a pretty basic question, but there's this argument that if you have a one-time price shift with tariffs, they don't actually translate into higher inflation longer term, just because if you dampen demand, well, guess what? You don't have that kind of inflation.
Yeah, that's right. That would dampen inflation to a degree. And also when we look at the tariffs, one-off price change versus potentially a sustained increase in prices. We do think the tariffs should be a little bit inflationary, but you're right that if we get some slower growth there, we get a lot of uncertainty, especially on the business level. If we get this on again, off again tariffs, that slows down activity, and maybe inflation doesn't accelerate the way that it would have minus all that anxiety. But we still think inflation is going to be sticky. It's hard to see it come significantly lower given all the things we're seeing right now, especially with tariffs.
How complicated is the situation in terms of U.S. rates when you have rates globally in the developed world going up on the heels of fiscal spend elsewhere?
Yeah, very. It complicates the issue. When we look at the global markets, one thing we've looked at for a while is just that yield advantage that the U.S. offers. And it's still relatively wide right now, but it's come down a little bit. But you also have to factor in the dollar. And if we're seeing other yields rise across the globe, we've seen a weaker dollar lately, that can impact how attractive global investments could be. So it is something we're looking at right now, but it also complicates the issue here in the U.S. All these things, we just see a lot of volatility right now. So the guidance we're providing is to not make a crazy move in either direction. We're not super short duration. We're not super long duration. We're really just at your benchmark duration until we get more clear signs that either growth is slowing significantly or inflation's reaccelerating.
I feel as though the message has been clear from the Treasury Secretary, though, in terms of this is a transition. He also, over the weekend, did not rule out, say there's no guarantees that we can't have a recession. Are they preparing America potentially for this quote-unquote transition, a.k.a. maybe a recession?
They could be. I mean, they are laying the breadcrumbs out there for what we could expect. I think given where we were coming into the year, valuations were pretty stretched across the board, whether it's equities. I'm not an equity guy, but I know that PEs are relatively high. But we saw that in the credit markets also, very low credit spreads. So a natural correction can be considered healthy. I think the swiftness is what's capturing a lot of investors' attention, and will it be prolonged? I think it's easy to say that now when we're down, 10% or less with stocks, and the rising credit spreads it was sharp, but they're still low. If we see that continue and that 10% decline in equities becomes a 20% decline, maybe that message changes a little bit.
Do we see the Fed chair potentially dangle a rate cut?
I don't think so. They want to stay as apolitical as possible. So I think they'll lay out kind of the dual risks they have. I think they won't mention it in this statement, I'm sure, but Powell will get the question about all the uncertainty, the political uncertainty we're seeing, and how that's playing into their outlook, especially inflation expectations. I mean, we saw the jump with the University of Michigan last week. I don't know how much they weigh that versus market-based, but there's so many different indicators out there. You can't ignore that jump that we saw in that 5 to 10 year inflation expectations, highest since I think the early 90s or so. So they'll try to stay away from the political fray, but they clearly have to be considering these potential outcomes as they're coming up with policy.
One of the biggest reasons we pay attention to you, Mitch, is because they do. They responded to it so quickly in the rate hiking cycle of a number of years ago.
That's why the most interesting move on Friday was not stocks selling off in the heels of some sort of negativity. It wasn't necessarily long-term bonds selling off in terms of long-term inflation expectations. It was the short end on expectations that the Fed would have to respond to the University of Michigan sentiment inflation survey and not cut rates more quickly.
It was easy to stand on the sidelines and say you don't want to talk about policy when there wasn't any policy. There's some policies now. We've got some tariffs. They've got to respond to that in the news conference on Wednesday.
They have to answer the question, are they inflationary? Are you modeling into your base case that this is going to structurally be more inflationary? And do you have to fight that with Fed policy at a time of weakening growth?
Get them to say the transitory word in the news conference.
That's not going to happen.
Yeah?
Is that what you're going to go for?
I'm not going to be there. Mike will be. Collin, it's good to see you. Appreciate it. Thank you. Collin Martin there of Charles Schwab. Equities just turning positive as we inch closer towards the opening bell. That opening bell about 42 minutes away. Equities up by about 0.1%. With an update on stories elsewhere this morning with your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. President Trump says that he will speak to Russian President Vladimir Putin tomorrow, pressing for an end to the war in Ukraine. Trump says they will focus on territory, power plants, and dividing up certain assets. Speaking to reporters on Air Force One, the president said, "We are doing pretty well with Russia, and there is a very good chance for a deal." Elsewhere, Oracle is accelerating talks with the White House on a deal to run TikTok. Politico reporting that the U.S. administration has significant concerns about what role the app's Chinese founders will play in its ongoing American operation. Vice President J.D. Vance says that he expects President Trump to wrap up a deal for the popular app ahead of next month's deadline. And in sports, Newcastle upset Liverpool to win the Carabao Cup final 2-1. It's the Magpies' first domestic trophy in 70 years and their first overall since 1969. Elsewhere, the Players' Championship is headed for a 3-hole playoff after Rory McIlroy and J.J. Spaun tied in yesterday's play. McIlroy is looking to secure his 28th career PGA Tour victory. And that's your brief. John.
Danny, thank you. Thanks for this morning. I think that playoff begins in about 11 minutes' time, so I'll be at my desk watching the golf.
How do you know?
I have no idea. Here so quickly.
I know.
Can I just take a beat? Congratulations to Newcastle fans. If you're not familiar with Newcastle fans, genuinely, they are some of the best fans on the planet. Win or lose, they sell out that stadium every single week they play at home. I couldn't be happier for you all. Just absolutely fantastic.
And that game made people also want to be a Newcastle fan because they played really well, and Liverpool, not so much.
I remember the Christmas holiday period going back years. Okay, there was a game in the Midlands, West Brom versus Newcastle. It's freezing, okay? Behind the goal, Newcastle fans, shirts off in the freezing cold. And they travelled down from Newcastle, which must be like a 5-hour drive or something. Absolutely ridiculous.
Is it passion? Is it crazy?
I think it's a little bit of both. It's a little bit of both. Congratulations to you all. Up next on the programme, let's set you up for the day ahead. That's around the corner from New York. This is Bloomberg. Equity futures turning positive briefly. Equity futures just about positive on the S&P and up 0.2 on the Nasdaq 100. As we count you down to the opening bell, here's the trading diary for the week ahead. On Tuesday, President Trump speaking with the Russian leader Vladimir Putin. Wednesday, a Bank of Japan rate decision. Then at 2 p.m, it's the Fed's turn, followed by a Chairman Powell news conference later that afternoon. On Thursday, a Bank of England rate decision plus another round of jobless claims and earnings from Nike and FedEx after the closing bell. Joining us now for some final thoughts, Bloomberg's Tyler Kendall down in Washington, D.C. Tyler, welcome back. That call coming up in the next 24 hours. How high are the stakes?
Oh, well, incredibly high, John. And of course, it comes on the heels of Annmarie's scoop that Special Envoy Steve Witkoff was in Russia last week negotiating face-to-face with Vladimir Putin. Now, President Trump has said that he feels that this could be a chance for some very good progress and that he has the potential to potentially announce a deal after that call. He previewed that land territory will be one of those big concessions that we are going to look for. Also saying that energy infrastructure as well as power plants are something that they are trying to figure out the path forward here. National Security Advisor Mike Waltz over the weekend saying that they know all the components for the deal. Now they are just trying to hammer it out.
Tyler, you've got to lean against the wind and tell me you need to seek shelter. You make it really dramatic. Got to make it more dramatic than it is. Tyler, I appreciate it. Tyler Kendall down in Washington, D.C. Stay safe. The weather's been absolutely brutal over the last few days.
I think there was plenty of inherent drama there. You could hear the cans kind of blowing behind her and her hair.
The North Lawn can get very dramatic, especially when they bring out the lawnmowers as well, not just the wind.
That's about as dramatic as it gets for a reporter in the White House, eh?
Well, I don't know about
the
that.
lawnmowers coming out first thing in the morning.
For a broadcaster, it's a little dramatic.
All right, coming up tomorrow, let's get to the lineup. Peter Chi of Academy, Kit Jukes of SocGen, Tom Becker of BlackRock, Stephanie Roth of Wolfe Research, joining us to break down the first day of a two-day meeting for the Federal Reserve. It will conclude on Wednesday, and it's going to be a fascinating one. This White House is not blinking, will Chairman Powell.
At a time when you have inflation expectations that are climbing, a lot of people aren't expecting that. Do they expect higher inflation and slower growth going forward? And how do they message that?
Look out for those forecasts on Wednesday afternoon. Live from New York City this morning. Good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.